Ms Livingstone, could I ask you first whether you'd prefer to make an oath or make an affirmation?
I'll make an oath, thank you, Commissioner.
Thank you. Swear the witness, please.
I swear by Almighty God.
I swear by Almighty God.
That the evidence I shall give.
That the evidence I shall give.
Will be the truth.
Will be the truth.
The whole truth.
The whole truth.
And nothing but the truth.
And nothing but the truth.
Thank you very much. Do sit down, Ms Livingstone. Yes, Mr Finch.
Thank you, Commissioner. Ms Livingstone, I think your full name is Catherine Bridget Livingstone.
That's correct.
Your business address is 201 Sussex Street, Sydney.
Yes.
You're the chair of the CBA.
That's correct.
And I think you're here pursuant to a summons dated 9 November 2018.
Yes.
Do you have a copy of the summons there with you?
I do.
I tender the summons, Commissioner.
Summons to Ms Livingstone is Exhibit 7.27.
Nothing further, Commissioner.
Thank you. Ms Orr.
Ms Livingstone, you've been a member of CBA's board since the 1st of March 2016
That's correct.
and the chair of CBA's board since the 1st of January last year.
That's correct.
Now, before you joined CBA's board, you were a member of the board of Telstra.
Yes.
You became a member of Telstra's board in November 2000.
Yes.
And you were appointed chair of Telstra's board in May 2009.
That's correct.
You've also been the chair of the CSIRO.
Yes.
And a member of the boards of Macquarie Group Limited, Goodman Fielder Limited and Rural Press Limited.
Yes.
And from 1994 to 2000, you were the CEO of Cochlear Limited.
Yes.
So you have experience at senior levels in the healthcare, science and research, food, media, telecommunications and financial services industries.
That's correct.
Now, reflecting on your time in those different industries, do you think that there are particular features of the financial services industry that mean there's a greater risk of misconduct in that industry or conduct that falls below community standards and expectations?
Yes, I think there is.
And what are those features that give rise to that greater risk, Ms Livingstone?
Well, I think starting with the degree of regulation, so it's a more highly regulated sector than almost any other. And of course, it's the products that it offers go to the heart of what is very personal to individuals. So it's their financial well-being.
Now, as a director and as the chair of CBA, you've presided over a difficult time for the bank.
I would agree with that, yes.
And we've heard evidence from Mr Comyn about a number of events in that time, but I want to take you through the sequence of some of the events after you joined the board of CBA.
Mm-hmm.
In March 2016, shortly after you joined the board, Four Corners and Fairfax Media reported on a number of concerns about ComInsure's life insurance business, including about the definition of heart attack used by ComInsure in its trauma policies.
Yes.
That was March 2016.
Yes.
And then about 6 months later, in October 2016, ASIC released its report 499 in relation to fees for no service.
That's correct.
And the report said that CBA had identified systemic issues in relation to the charging of ongoing service fees.
Yes.
And that CBA estimated at that time that it would need to pay over $100 million in compensation to customers who'd been charged a fee for a service they didn't receive.
That's correct.
And then a couple of months after ASIC's report into fees for no service, in December 2016, shortly before you became chair, CBA entered into an enforceable undertaking in relation to ASIC's concerns about CBA's wholesale spot foreign exchange business.
Yes.
And then in May 2017, PwC completed a targeted review into CBA's home lending practices and identified concerns with CBA's processes for verifying the financial circumstances of borrowers and its processes for monitoring serviceability overrides.
Yes.
In August last year, AUSTRAC commenced the civil penalty proceeding against CBA that I've discussed earlier today with Mr Comyn.
Yes.
And CBA agreed to pay a penalty in respect of the contraventions alleged in that proceeding of $700 million.
That's correct.
And later that same month, CBA announced that it would be refunding $10 million to 65,000 customers who'd been sold unsuitable credit card insurance.
That's correct.
And towards the end of that month, where in August last year, APRA announced that it would conduct its prudential inquiry into CBA.
Yes.
Then in December last year, this Royal Commission was established. And in January this year, ASIC commenced a civil penalty proceeding against CBA, alleging unconscionable conduct and market manipulation in relation to CBA's involvement in setting the bank bill swap rate in 2012.
Yes.
And CBA agreed to pay a total of $25 million in relation to that proceeding.
Yes.
And entered into another enforceable undertaking with ASIC.
Yes.
Then in May this year, APRA released the final report of the prudential inquiry, and CBA entered into an enforceable undertaking with APRA in relation to the recommendations in that report.
Yes.
And under that enforceable undertaking, CBA was required to submit a remedial action plan responding to each of the recommendations made in the final report.
Yes.
And CBA was required to appoint an independent reviewer to monitor CBA's compliance with that remedial action plan.
Yes.
And to provide a report to APRA showing how the findings of the prudential inquiry were reflected in the remuneration of current and past CBA executives.
Yes.
And as a result of the findings of that inquiry, APRA added $1 billion to CBA's minimum capital requirement.
Yes.
What are the practical consequences for CBA of a $1 billion increased capital requirement?
Well, literally that you have to hold that additional capital, and that effectively reduces your profitability. But it's actually intended to cover the consequences if there were an operational risk incident, because it's operational risk capital that we are required to hold. The extra is operational risk capital.
And finally, in this sequence of events, in July this year, CBA entered into another enforceable undertaking with ASIC in relation to the way that it distributes certain superannuation products.
Yes.
Now, I want to ask you some questions about the board's role in addressing some of those events and the causes of some of those events. But before I do that, having heard me lay out that chronology of events since your time joining the board of CBA, are there any observations that you'd like to make about that chronology of events?
I think it's a fairly damning chronology of, in some instances, the bank's behaviour, in other instances, the bank's control over its non-financial risks.
Now, CBA's board has 4 permanent standing committees, is that right?
That's correct.
They're the Audit Committee, the Risk Committee, the Remuneration Committee and the Nominations Committee.
Yes.
And you're a member of each of those committees?
As chair, yes. And I chair the Nominations Committee as well.
And I want to make sure that I understand the role of each of those separate committees. The Nominations Committee is responsible for the appointment of board members and the CEO, is that right?
Yes. Yeah.
And you've been the chair...
Well, sorry, the board ultimately appoints the CEO, but the Nominations Committee will do, if you like, the groundwork in relation to it.
Thank you. And you've been the chair of the Nominations Committee since you became chair of the board?
Yes, that's correct.
And the Remuneration Committee oversees the bank's remuneration policy?
Yes.
And it makes recommendations to the board about the remuneration of the CEO and senior executives each year?
That's correct.
And you've been a member of the Remuneration Committee since you became the chair of the board?
Yes.
Now, the Risk Committee and the Audit Committee both play an important role in the board's oversight of CBA's risk management framework. Do you
Yes.
agree with that?
Yes.
And I want to understand a bit better how that works in practice. APRA's prudential standards require CBA to have a risk management framework, is that right?
That's correct.
And it's the board's responsibility to oversee that risk management framework?
Yes.
And it does that both through the Risk Committee and the Audit Committee?
Well, the Risk Committee has a primary carriage in terms of compliance with CPS 220, which is the APRA standard, and the role of the Audit Committee in relation to the Risk Committee is to advise if there are any observations from the assurance function, which would come through the Audit Committee, that have implications for the control environment. The Audit Committee refers that matter to the Risk Committee, so the Risk Committee can take it into account in its assessment of the risk management framework.
Thank you. Can you explain what a risk management framework is?
Yeah, so it's the overall way the organisation is organised to identify, manage and mitigate the risks of the organisation. So it starts with the business plan, because that defines the business you're in. In our case, it obviously also includes what we call the risk management approach, which is the overarching governance approach, and a risk appetite statement. And then underneath that, you define the risks that you are managing, which in our case, obviously, is the financial risk, so market risk, liquidity risk, capital risk, and the non-financial risks. So they've traditionally been described as operational and compliance risks, but we now take those down to a more granular level. So we identify the specific risks, such as conduct risk, and so on, that fit under that non-financial risk category.
And the board's responsible for setting a risk appetite in relation to both the financial risks and the non-financial risks?
That's correct.
And for approving a risk management strategy, which describes how the risks are going to be managed so that they stay within the appetite. Have I got that right?
That's correct.
And each year, CBA is required to conduct an audit of the effectiveness of its risk management framework.
That's right. And every 3 years, an independent audit.
Yes. And as part of that audit process, CBA conducts audits of the different controls that it has in place to make sure that it stays within the risk appetite?
That's right, through the various assurance function activities, yes.
So is that an example of one of the controls, the assurance function?
Well, the assurance, it's one of the elements of the risk management framework. The assurance function actually looks at specific controls in particular areas.
So can you give an example of a control?
So, for example, if you take the mortgage business, so there would be controls over entry of borrower data, or compilation of the living expenses, for example, or their other financial institution borrowings. So there'll be controls over various elements of the process. So you have to start with a process and then identify the control points in the process, and then assurance looks at those control points. And then from that, you can draw a conclusion as to whether you are within risk appetite.
And the audits that look at...
Sorry to interrupt, but it looks as though the whole of the system is having a quiet little nervous breakdown on us at the moment. We have neither transcript nor the evidence screen, and I suspect the feed has probably gone down as well. I think we've got no choice except to stop for a time, and if somebody can let me know when the system is back up. You are privileged, Ms. Livingstone. You have all aspects of the system go down around you. I'll
long as I
come
don't feel
back when
responsible.
I'm told that it's back up, is all.
Thank you, Commissioner.
I'm sorry about that, Ms Livingstone, but these things happen.
Indeed, Commissioner.
Might just check before I commence, Commissioner. All right. Ms Livingstone, I had been asking you questions about the different controls that are in place to make sure that CBA's risk remains within its risk appetite. We had been speaking about the assurance or audit function and the role that it plays in assessing those controls.
Yes.
And the results of the audits are reported to the Audit Committee, is that right?
That's correct.
And you've been a member of the Audit Committee since you joined the CBA's board in March 2016.
I think that's right.
And you've been a member of the Risk Committee since you became chair in January last year. Now, I want to ask you a bit about each of those different roles that you have within CBA, starting with your roles as a member of the Risk and the Audit Committees and as chair of the board.
Yes.
Now, CBA's board, as we've just been discussing, is ultimately responsible for the way that CBA manages risk. Do you agree with that?
Yes, I do.
And that includes the financial sorts of risks that you mentioned before, credit risk, liquidity risk.
Yes.
But it also includes non-financial risks like conduct risk, compliance risk, reputational risk.
Yes.
And would you agree that failings in CBA's governance and risk management arrangements contributed to the misconduct and conduct that fell below community standards and expectations that's occurred at CBA in recent years?
Yes, I would agree with that.
The final report of the Prudential Inquiry into CBA made a number of criticisms of CBA's governance and risk management arrangements.
Yes.
And a fundamental finding in that report was that the degree of attention and priority given to the governance and management of non-financial risks within CBA was not to the standard that would, in the words of the panel, have been expected in a systemically important bank.
That's correct.
And you agree with that assessment?
I agree with it.
And the Prudential Inquiry found that the board, together with its risk, audit and remuneration committees, demonstrated significant shortcomings in the governance of non-financial risks.
That's correct.
And this was one of a number of concerning findings that were made by the panel about the board. Do you agree with that?
Yes, I do.
And some of the others included that the board did not demonstrate sufficient rigour and urgency in holding management to account.
That's correct.
Do you agree with that?
Yes.
The board had not sufficiently challenged management. Do you agree with that?
Yes. I mean, when I'm agreeing in terms of in the past,
Yes.
but that's not necessarily the case now.
I understand. And the panel also found that the board had not insisted on improvement by management.
That's correct, generally. Yes.
And that the effectiveness of the board and its committees was hampered by gaps in reporting to the board and the committees. Do you
That's
agree with
correct.
that?
Yes, I do.
And the board didn't set a clear tone from the top in relation to the management of non-financial risks.
That's correct.
You agree with that finding?
Yes, I do.
Now, the Prudential Inquiry said that those findings related largely to the operation of the board prior to your appointment as chair.
They made several references to that effect, yes.
Yes. But you were a member of CBA's board for 10 months before you were chair?
That's correct, 10 months, but probably 5 or 6 meetings.
Over the course of that 10 months?
That's correct, because I had leave of absence for the June meeting.
And what were your views of the operation of the board during that time under the previous chair?
So I was quite surprised by the lack of challenge.
What surprised you about it? Was it inconsistent with the style and frequency of challenge that you'd seen on the other boards that you'd been part of?
That's correct.
So you were surprised by the lack of challenge. Did you have any other views of the operation of the board during that 10 months before you took over as chair?
Well, I think the point that the Prudential Inquiry made about the follow-up of issues, I think the urgency there and the degree of follow-up in general terms was not what I'd been accustomed to.
So there was insufficient follow-up of issues by the board, follow-up of management?
That's right. I mean, insufficient in terms of over time as distinct from the follow-up itself, as in the follow-up would take too long.
The follow-up would take too long. Do you mean by that the board waited too long for the
Yes.
results of that follow-up?
Yes, and to ask the next question, yes.
All right. So you said there was insufficient urgency in the board's approach to follow-up.
Yes, that's correct.
So there were too few questions asked of management. That was, I think, the first point that you made. Insufficient challenge.
Insufficient challenge, and again, as the inquiry highlighted, too much store placed in assurances from management, which was effectively then led to insufficient challenge, so it was somewhat circular.
So too few questions asked of management and too little follow-up after those questions were asked. Is that
Yes.
a fair summary of that?
Yes, it is.
And that surprised you based on your experience on other boards?
Yes, it did.
Did you discuss your observations with any of the members of the board, or including the chair of the board?
When in the August, I think it was around the August time frame after I joined, which would have been my third meeting, I think the chair did a performance review by having one-on-one meetings with individual directors. And I think I may have raised at that time just the style of the board, but I can't recall exactly.
You may have raised the style of the board, did you say?
Yes, but I can't recall exactly because yes, no, I can't recall.
Do you recall raising any of the matters you just identified for me?
I can't recall specifically, no.
Or did you take any steps as a member of the board? Did you take any steps to address the concerns that you had?
Well, as a new member of the board and 3 meetings in at that point, you're still trying to get a feel for how the board works. You can't form judgments immediately on how a board functions after 2 or 3 meetings usually. So in fairness, you would generally wait up to 6 months before forming a view.
You wait up to 6 months as a director of a board before forming a view on the operation of the board?
Before forming a definitive view, because you haven't seen a full cycle of meetings and activities of the board.
But
you don't also, you don't also have the detailed knowledge of all of the issues at that point.
But you had seen enough of the way the board operated to form these concerns?
They had formed the concerns, yes.
And you didn't take any steps to address those concerns at that point?
At that point, I was still forming my view.
Now, I want to come to some of the changes that have been made since you became chair of the board. But before I do that, I want to ask you about 3 aspects of the board's involvement in CBA's governance and risk management arrangements. The first is the way that the board and its committees respond to misconduct and compliance issues when they're brought to the attention of the board. And the second is the way that the board and its committees are positioned to identify new misconduct and compliance issues. And the third is the tone that the board sets in relation to the management and importance of misconduct and compliance issues. Those are the three topics that I want to deal with. So I want to start with the first of those, which is the way that the board and its committees respond when misconduct is drawn to its attention. And I want to deal with this by asking you about the way that the board dealt with the anti-money laundering and counter-terrorism financing breaches that became the subject of the civil penalty proceeding brought by AUSTRAC last year. Now, you may have heard me ask some questions of Mr Comyn about these matters.
Yes.
You saw that evidence, Ms
Yes.
Livingstone?
Yes, I did.
And the questions that I put to Mr Comyn were focused largely on the handling of those AUSTRAC issues by management, in particular by the executive committee. But I want to ask you about the handling of those issues by the board.
Yes.
Now, do you agree that the AUSTRAC contraventions demonstrated significant failings in CBA's management of risk?
Yes, I do.
And CBA's internal audit department had identified issues with CBA's processes for complying with those legal obligations many years before AUSTRAC commenced its civil penalty proceeding in 2017.
That's correct.
The issues were identified by the audit department in 2013,
Yes.
and they were identified again in 2015,
Yes.
and they were identified again in 2016.
Yes.
And in each of those years, the audit reports rated anti-money laundering and counter-terrorism financing with an overall red rating.
That's correct.
What does an overall red audit rating mean, Ms Livingstone?
Well, it's the most serious rating you can have on an audit report, and in relation to the controls in the relevant area, that it would indicate that the area is not in a state of control.
The controls are failing.
Yes.
So red audit ratings for the controls in that area in 2013, 15 and 16.
That's correct.
And the findings of each of those audits were reported to the audit committee?
I believe they would have been.
Yes. Well, you weren't on the board in 2013 or 15.
No.
But you were a member of the board and the audit committee in 2016.
That's correct.
And throughout 2016, the board received documents called regulatory reports. Is that right?
Yes, that's right.
And can you explain what a regulatory report is?
The regulatory report covers a range of regulatory matters. It'll be interactions with regulators, it'll be breaches, and it will be changes in the regulatory environment in terms of new regulation.
So does it include an update for the board on any significant regulatory interactions that
Yes.
CBA is having?
Yes, it does.
Now, on the 8th of November 2016, the board received a regulatory report which included information about CBA's interactions with AUSTRAC. You familiar with that?
Yes.
Now, I'll show you that regulatory report, which is CBA 0502 0001 6960. So we have there a copy of the regulatory report provided for the board dated the 8th of November 2016.
That's correct.
Now, if we bring up 2 pages within that document together, could we bring up 0010 and 0011? Now we have 0010 on the screen, and hopefully we'll also be able to bring up 0011. But at 0010 you can see the start of the update that the board received about CBA's dealings with AUSTRAC. You see that towards the bottom of the page?
Yes, I do.
The document recorded that on the 22nd of June 2016, a statutory notice had been received from AUSTRAC's enforcement team for the production of information and documents relating to CBA's compliance with AUSTRAC's customer onboarding and ongoing customer due diligence requirements. You see that?
Yes, I do.
And the report also said that on the 2nd of September 2016, a second statutory notice had been received from AUSTRAC.
Yes.
And then over the page, we see a reference to the 14th of October 2016. CBA responded to the second statutory notice and also received a third statutory notice from AUSTRAC.
Yes.
So by the beginning of November 2016, CBA had received 3 statutory notices from AUSTRAC requiring it to provide information about its anti-money laundering and counter-terrorism financing compliance.
That's correct.
Now, you were present at the meeting of the board at which this regulatory report was discussed.
Yes.
I want to move to the minutes of that meeting, but first could I tender the regulatory report?
Regulatory report 8 November 16 CBA 0502 0001 6960 Exhibit 7.28.
Have you reviewed the minutes of that meeting on the 8th of November 2016, Ms Livingstone?
I may have. I can't immediately recall.
Well, I want to put to you, and I'll bring the document up to assist you, that they record no more than that the board was told that there had been no further statutory notices since the third statutory notice, and that the board discussed and noted this report. Would you like me to show you the document so you can see that reference?
Well, no, I think that's fine because...
Does that accord with your recollection?
Well, not completely. So, but either at the October meeting, and I think it was the October meeting because I think by then the second notice had been received. I challenged management about why were we getting these notices, what was behind them, and was AUSTRAC concerned about something. And so the answer I received was, well, AUSTRAC knew that we were working hard and investing in our financial crimes compliance platform, but that we weren't fully compliant at that time, and that there was significant work and significant investment going on, and that we were maintaining contact with AUSTRAC. And in addition, the then CEO of AUSTRAC had actually met with the board at its June 2016 meeting, at which I was not present, but had not raised any issues with the board at that meeting. I have to say I was concerned about the fact of the notices, and I'd had experience with AUSTRAC in a previous role, so it didn't feel quite right to me that AUSTRAC would be comfortable with where we were, but management provided assurances that they were fully informed about the situation in terms of our level of compliance.
When you say management, who provided those assurances?
The CFO did.
So you say that this happened at the October meeting.
I think it was at it was either the October or December. It wasn't at the November meeting, so I think it might have been October.
So around this time, at a meeting at which you were told that these notices had been issued, you, as you describe it, challenged management about that, and you were given the assurances that you've just described from the CFO.
Yes, but I didn't feel comfortable with those assurances.
And what did you do given that you didn't feel comfortable with those assurances?
So by that time, it had already been was being announced that I was becoming chair of CBA from the 1st of January. So as soon as I came into the chair, as a matter of good governance, I arranged to see each of our major regulators to introduce myself in my new role, and included AUSTRAC as one of the regulators I went to see almost immediately as I came into the role.
So was that in January
That was in
2017?
January, yes.
So can we come to January, because I want to move through these events before January. So there's the meeting which you think was either October or December, where you challenged management and received the assurances.
Yes.
The third of the three overall red audit results that I referred to earlier was produced on the 5th of December 2016. Is that right? I should be clear, that's the date on which it was reported to the audit committee.
Okay.
Does that sound right to you?
It sounds right, yes.
So do you think that that report to the audit committee happened before or after the discussion that you're describing with the CFO at a board meeting?
So I think, and I'm just not sure about my memory, I think it was at the October meeting that I raised the issue.
Okay.
I think it was.
So let's work on that assumption for now, that you raised those matters and received those assurances at the October meeting. And then there was the document that's on the screen at the moment, the regulatory report dated the 8th of November 2016, which confirmed that there had been 3 notices in total. Then on the 5th of December 2016, the third red audit report was reported to the audit committee, and you were present at the meeting of the audit committee at which that audit report was discussed. Is that right?
That's correct.
Now, can I take you to a document about that meeting? CBA 0502 0001 1265. Now, this is the agenda for that meeting of the Audit Committee on the 5th of December 2016.
Yes.
And we see from the agenda that the meeting was scheduled to start at 1:30 in the afternoon and to finish at 3:20 in the afternoon, so just under 2 hours.
That's correct.
And we see from items 5, 6 and 7 on the agenda that 30 minutes of time was allocated to 3 items: the audit report, the group audit and assurance report, the Group Audit and Assurance Charter Biennial Review, and the key audit themes for the 6 months ended the 31st of October 2016.
That's correct.
Now, can I take you firstly to the paper that corresponds to item 5, the Group Audit and Assurance Report, which is at 0037. CBA 0502 0001 1265 0037.
Sorry? I have no idea what's going on.
I'm sorry, Commissioner, I don't think this is a topic I can deal with
No, I understand
without
that.
the document
I
to
understand
assist
that.
Ms Livingstone.
Yeah, I understand that.
Are there hard copies I could have a look at?
There may be, but I think the Commissioner and others will need the version on the screen. So, ask you for the 0041 document.
Sorry, section 4.1, do you mean? Or
I'm sorry, it's the attachment to the
sorry.
paper,
Yes.
which is at page 0041.
Page is now up.
yeah.
So the attachment that you have in front of you now is a summary of the results of all the reports issued by Group Audit and Assurance in September and October 2016.
That's correct.
And does each line in this table summarise the contents of a separate audit report?
Yes, it does.
And we can see that there were 3 areas identified with an overall red rating: anti-money laundering and counter-terrorism financing, special audit on non-performing loan client, and the Commonwealth Financial Planning ongoing service matter.
That's correct.
And the anti-money laundering and counter-terrorism financing entry records that the control environment was rated unsatisfactory, management awareness and actions were rated marginal, and the overall rating was red.
That's correct.
The last of the 3 overall red matters is the fees for no service matter that was the subject of a case study in the 2nd round of hearings.
That's correct.
Now, down the bottom of the page, underneath the table, the first line we see there is that copies of all audit reports are available upon request. Do you see that line under the table?
That's correct.
And having received this document with the 1-line summary of the 3 red audit reports, did you request a copy of any of the audit reports?
No, I did not. As the Prudential Inquiry report raised, the chairman of the audit committee provided the briefings on the audit reports. We should have asked for the detailed audit reports, but we didn't.
Well, to your knowledge, did anyone else on the audit committee request a copy of any of the audit reports?
I don't know that answer to that, Ms. Orr.
You say you didn't and you should have.
That's correct.
And during your time on the audit committee prior to the Prudential inquiry, the APRA Prudential inquiry, do you recall anyone on the audit committee ever requesting a copy of an audit report?
No, I don't recall that they did.
You don't recall anyone ever doing that on the audit committee?
I don't recall that they may have, but I don't recall.
So the only detail the audit committee had about the nature of the audit failings, which was the substance of the work it had to do, was the information contained in the lines in this sort of document, this sort of attachment.
No, there was a full briefing from the chair of the audit committee and the head of group assurance.
I'll take you to that as well. So there was the discussion that's recorded in the minutes, and in addition to that discussion, there was this style of document, this attachment that summarised the results of the audits. Is that right?
That's right. There would be another, because this is a review of 6 months, there should be another page.
It says for September and October 2016.
But there should be another page in the group assurance report which actually describes the audit itself.
Well, let's look at, you're talking about paper presented by the group audit and assurance.
There should be in there, yes.
All right, let's go back to the paper to which the document is attached. That's back to 037. And I'll take you through what's said about this matter in that paper. In the executive summary, we see at 3.1, despite improvements in anti-money laundering and counter-terrorism financing over the last 2 years, our audit outcome was red. A large number of AML CTF issues continue to exist across the group. Many of these have been self-identified by Line 1 and Line 2, which has driven an improved management awareness rating. There are also a number of issues that remain from our 2014 AML CTF audit and repeat issues because necessary controls have not been suitably designed. Know your customer error rates remain too high in certain business units. So that was the executive summary reference to this particular audit.
That's correct.
And it was clear from that paragraph that there'd been audit failings in previous years in relation to the anti-money laundering and counter-terrorism financing systems at CBA.
That's correct.
There was a reference to the 2014 audit report.
Yes.
Did you request a copy of that audit report?
No, I didn't.
To your knowledge, did anyone else on the audit committee request a copy of that audit report?
Not to my knowledge.
And if we keep that page on the screen and bring up at the same time the following page, we can see what the report said under the heading Anti-Money Laundering Counter-Terrorism Financing Red. Do you see that at 4.2 at the bottom of the first page?
Yes, I do.
A large number of AML CTF issues continue to exist across the group. 2/3 of the issues were raised by Line 1 and Line 2, together with new issues found by our audit. Issues include a significant number that remain open from our prior CTF audits due to delayed remediation and repeat issues resulting from fixes not being suitably designed. And paragraph 4.2.2 also dealt with this matter, and you'll see the reference in the last sentence to know your customer error rates having improved across the group since the 2014 audit, but some business units lag behind with significant error rates self-reported in business and private bank, over 20%, and to a lesser extent in wealth management, 8%. You see that?
Yes, I do.
And I'll let you read the remaining paragraphs before the next heading, wealth management advice, if you would like to, so that you can see the full extent of the information provided in this paper.
If we take the pop-up down, yes.
Yes.
So that is the information contained in the document about these particular issues, the anti-money laundering and counter-terrorism financing issues.
That's correct.
And you would have seen from that information that repeat issues were occurring because CBA hadn't designed suitable and necessary controls.
That's correct.
And that the know your customer error rates in some business units were over 20%.
Yes.
Now, the issues that were remaining from the 2014 audit that had not been addressed, based on this document, what did you understand the nature of those issues to be?
I think on the 2014 audit, I think that was a transaction monitoring.
Did anyone
audit.
tell you that? It's not clear from this document.
No, but in terms of this whole area, I've sought to inform myself, obviously, with the AUSTRAC issue as to exactly what happened.
But at this point, at the Audit Committee meeting on the 5th of December 2016, did you have information that allowed you to understand what the 2014 problems were that were outstanding?
I can't recall, honestly, I can't recall.
As a
But I do recall in terms of discussion and the assurance from management again as to what was being done, and particularly in relation to the KYC and the Auckland hub in particular.
Well, I want to come to the minutes of the meeting so that we see what's recorded as to the discussion of this paper, but do you accept that this was the information provided to the Audit Committee about these issues for the meeting on the 5th of
Yes,
December
I do.
2016?
Yes, I do.
And as a member of the Audit Committee who received this report, what was your reaction to these matters?
Well, as I said, I was concerned about them and not confident in the assurances that I was receiving from management that AUSTRAC was aware of the progress that we were making in terms of our financial crimes compliance.
So do you think this was the meeting at which you expressed the concerns that you raised earlier with me?
It may have been. Honestly, I can't remember between the October and the December meeting which meeting it was I particularly raised the concerns.
I see. So do you remember what you said to management at this meeting in response to these issues?
I can't recall exactly at this meeting.
All right. Well, let's look at the minutes for that meeting, but I'll first tender the paper for the Audit Committee on the 5th of December 2016.
Audit Committee Papers 5 December 16, CBA 0502 0001 1265, Exhibit 7.29.
Now, the minutes are at CBA 0502 0001 1303. I assume you received the paper ahead of the meeting, Ms Livingstone?
Yes.
How far ahead of the meeting would you have received that paper?
At that time, it would have been probably just under a week, possibly.
Mm-hmm. And you read the paper?
Yes, I did.
And it concerned you?
Yes.
It concerned you insofar as it related to the anti-money laundering matters?
Yes.
But you did not seek a copy of the audit report?
No.
And you did not seek a copy of the 2014 audit report referred to in the paper?
No, I didn't, but I think it was pretty clear, even from the summary, how serious the issues were.
Well, what was clear about the 2014 issues from the summary, Ms Livingstone?
Well,
what did it tell you about them?
The fact that there were still issues from 2014.
Yes, but did
in
it
and
tell
of
you
itself.
anything about the nature of those issues? Did it tell the board what the problems were from the 2014 audit that were not addressed?
No, it didn't.
All right. So you then attend this meeting of the Audit Committee on the 5th of December 2016. We have the agenda on the screen at the moment, and this document includes the minutes. I'm sorry, this is the agenda for the February 2017 meeting, which annexes the minutes from the December 2016 meeting. I apologise if that confused you. I want to go to those minutes which are at 0002. We see from this page that you were present at this meeting.
That's correct.
And if we turn to item 5 at 0006, would be useful to have 0006 and 0007 on the screen together. We can see what was said about the audit and assurance report that I've just taken you to. And the minutes record under item 5 that Mark Worthington, he was the group auditor. Is that right?
That's correct.
The head of audit?
Yes.
He presented the report. And Aidan Gillies and Philippa Maiden attended and commented on aspects of the report. Now, what part of the business were Mr Gillies and Ms Maiden from?
So Mr Gillies would have been from the internal audit group, and Philippa Maiden was from Group Security, which was the group within financial services which had taken over responsibility for financial crimes compliance.
Okay, so you had a representative of the audit group beyond Mr Worthington, and a representative, is that the business unit responsible for the anti-money laundering systems?
That's correct.
And why were they invited to the meeting?
Because they would have been asked to be available to comment on the outcome of a red audit.
And we see that Mr Gillies commented upon the red rated report, noting that a large number of issues continue to exist. However, this audit also found that more issues were being self-identified, resulting in the management awareness and action rating moving from red rated to amber rated. You see that?
That's correct, yes I do.
And further down, we see that Philippa Maiden commented upon the reporting each day to AUSTRAC.
That's correct.
And after that, we see from the top of the next page that Philippa Maiden left the meeting.
Yes.
And Mr Gillies then updated the committee on the red-rated report for the CFP ongoing service issue, noting that it was red due to a weak controls environment.
That's correct.
And we see here that the minutes record that the committee expressed its disappointment that this has been found to still be an issue and asked management to explain the delay in remedying the issue. Do you see that?
Yes, I do.
And towards the end of that paragraph, the committee raised questions on various matters, including what staff behaviours, if any, needed to change and why the business had continued to charge the fee.
That's correct.
And then we see the committee discussed and noted, I'm sorry, we'll need to pan back. The final line is that the committee discussed and noted the group audit and assurance report.
That's correct.
Now, the minutes don't record the committee saying anything about the anti-money laundering and counter-terrorism financing audit issues.
No, they don't, but that wouldn't mean that there hadn't been a discussion.
No, we can see that there was a discussion, and the minutes tell us something about the discussion for the fees for no service issue. We see the expression of disappointment. We see the questions asked of management. We don't see any of that for the anti-money laundering matter, do we?
No, we don't.
Why is that?
I can't say why that is, but it would have been discussed.
And what do you recall of that discussion?
In the November meeting.
We're in the December meeting.
Oh, sorry,
now,
sorry,
Ms.
December
Livingstone.
meeting. I can't specifically recall the discussion in that.
Do you think that if the committee had raised questions about the matter, we would see that reflected in the minutes as we do for the fees for no service issue?
Yes, the minute should have recorded that.
And do you recall any questions being asked?
Well, as I say, I don't remember whether it was at the October or December that I particularly challenged this the situation in relation to the AML-CTF compliance.
All right.
I'm sorry, I just can't recall which it was.
The fact that it's not referred to in this document, does that suggest to you that it was not at this meeting?
It may, yes.
Would you expect the minutes to record where the audit committee has required management to respond to questions and provide assurances?
Yes, I normally would, yes.
Yes. Do you think that the committee took the audit findings in relation to the anti-money laundering and counter-terrorism financing issues seriously enough?
I think it's fair to say that not seriously enough, because there was, as I've said, the reliance on management's assurances about all the work that was being done. But as it's clear, there were still many issues that remained outstanding, notwithstanding the amount of money that had been spent and the time had been spent on upgrading the compliance.
What did you and the other members of the audit committee do to hold management to account for those failings and to require them to fix them?
Well, the discussion is and would have been how long is it going to take and what's happening. But I think, as is clear from what has happened, these matters were being addressed over time. It was taking too long, and there were always responses, yes, we're doing this, yes, we're spending that money. So those responses were taken as assurance that the issue was being addressed. But I absolutely accept that that was an inadequate conclusion on the part of the Audit Committee and the Board.
Did the committee do enough to make clear to management how urgent it was for these matters to be fixed?
I think it would have noted urgency, but probably the actual sentiment would not have conveyed the degree of urgency required.
We see no reflection in this document of any sentiment of urgency being conveyed.
Well, as I say, the minutes should represent fully the conversation, but they may not. But the discussion would have, and certainly the chair of the Audit Committee would have made a comment, as he always did, about the follow-up on the audit reports.
It's very important that minutes of board committees accurately reflect the discussions at those meetings, isn't it?
I agree.
Were you concerned that having an inadequate control environment for these sorts of matters might facilitate money laundering and drug distribution by criminal syndicates?
Well, I was absolutely concerned that if you have poor controls in this area, that could be an outcome.
And that is what occurred, isn't it?
It is.
And CBA admitted in the civil penalty proceeding that it had failed to report millions of dollars of suspected money laundering.
That's correct.
And that money was laundered through CBA accounts that included the proceeds of drugs and firearms importation and distribution syndicates.
Yes.
Now, do you think that you and your colleagues on the Audit Committee gave sufficient attention to the significant non-financial risks of CBA's failings in this area?
No, it did not.
And do you think you did enough to hold management to account to ensure that these problems were fixed and that they were fixed in a timely manner?
Not at this point.
Now, do you agree that beyond the AUSTRAC example, this was a period in which the board was not doing enough to address significant non-financial risks?
Yes, I do agree.
APRA had reached that conclusion, hadn't it?
Yes, it had.
Now, I want to take you to a document, but I'll tender first the agenda for the 5th of December meeting.
The minutes of the Audit Committee meeting held on 5 December 16, CBA 0502 0001 1303, Exhibit 7.30. Just before we leave that document, though, Ms Livingstone, at this time, by which I mean October, November, December of 16, do you have any memory of an issue being raised at board level or committee of board level about the use of intelligent deposit machines in connection with AML-CTF?
No, I don't, Commissioner, but I subsequently, if I could go to when I met with the CEO of AUSTRAC in January of 2017, I then went back through the papers to understand how I was not aware of the IDM machines issue, and I did find reference in one of the regulatory reports to the IDMs, but it was a relatively brief reference, and I suppose at that time the assumption was everyone on the board understood what the issue was because it was quite a few years old, so it was a fairly short reference at that point.
Yes.
But, sorry, the Section 167 notices, the references there did include the reference to the failure to lodge the TTRs.
Yes.
Ms Livingstone, you had accepted that this was a period in which the board was not doing enough generally to address significant non-financial risks.
Yes.
And I had said to you that APRA had reached that conclusion because in the months before you joined the board on the 1st of March 2016, APRA had provided CBA with a prudential review report dealing with CBA's operational risk management framework.
That's
Have you
correct.
seen that document,
Yes,
Ms
I have.
Livingstone? It's CBA 0001 0534 0001. So this is a letter from APRA to the CEO of CBA dated the 24th of December 2015 regarding APRA's prudential review of CBA's operational risk management framework conducted in November 2015.
Yes.
And the letter attaches a report and requires CBA to respond to the findings in the report by the 4th of March 2016.
That's correct.
And if we turn to 0003, we see under the heading Executive Summary that APRA's main concern following the review was that CBA's operational risk management framework is not effectively identifying, escalating and addressing significant operational risks. That's the first line under the heading Executive Summary.
Yes, that's correct.
And if we turn to 0006, we see that under the heading Actions, APRA required that CBA take the necessary steps to enhance the effectiveness and implementation of the operational risk management framework so that key risks are identified, escalated and addressed in a timely manner.
Yes.
Now, when you joined the board on the 1st of March 2016, was this report drawn to your attention?
No, it wasn't.
Would you have expected this report to be drawn to your attention, Ms Livingstone?
I think in terms of a new director, when you join the board, you build your knowledge generally, as I've said, over the first 6 months, so that these matters would have come up then during that period.
This was a very significant document for those on the board to have access to, was it not?
Yes, it is.
And does it concern you that it was not drawn to your attention?
Yes, it does.
When were you made aware of it?
Well, I think the first awareness would have been, I think, the response to APRA as required by this report, which would have come from the CEO. That letter, that would be attached to a regulatory report.
So do you remember someone drawing the response to this report to your attention?
No, not specifically, but I think it would have been part of the papers that I read.
And when did you receive it as part of those papers?
I think it would have been at the March meeting, which would have been my first meeting.
And is that, reflecting on that, is that an adequate series of events in relation to a document of this nature about CBA's operational risk management framework?
No, probably not. But as I said, when you join a board, your induction and your knowledge takes some months to acquire. And there were obviously quite a number of issues in the bank, and so it took some months for me to get fully conversant with all of the matters.
Well, that may itself be the issue, may it not, Ms Livingstone, that it does take a new director some months to become aware of what issues are alive and running within the organisation.
It does, and that's part of, if you like, having a board, so you don't have a whole board turning over at one go, so that you actually bring new members on. The rest of the board is aware of the issues, and as you bring new members on, they get briefed and they become aware of the detail.
Well, other organisations are used to assembling briefing papers to allow newly joining members to know what the current issues are. Is that not a practice that could be applied and modified?
I think, Commissioner, that's absolutely right, and we've looked at our director induction program in some detail now to make sure that it's a more fulsome induction than has been in the past, because the briefing pack that was provided was more the description of the organisation and how it runs as distinct from the issues.
It's not unknown in government, is it, to have briefing papers available for those who are to take responsibility for certain functions of government, whether after election or otherwise. Is that so?
No, that's correct, and that would be much better practice.
Is it not possible to apply something of that kind to the organisation of a board of an organisation as large and sophisticated as CBA Group?
Indeed, it is that. That would be the better practice, and that's in terms of our current induction program, that will be our practice.
Yes, Ms Hall.
Could I tender that document, Commissioner?
Letter APRA to Narev, 24 December 15, concerning operational risk framework and attached report, CBA 0001 0534 0001 Exhibit 7.31.
So, Ms Livingstone, moving much further forward in time, in May 2018, when the report of the Prudential Inquiry was produced, the panel raised very similar concerns in relation to the way CBA identified, escalated and addressed non-financial risks as those contained in this communication from APRA at the end of 2015. Do you agree with that?
Yes, I do.
And the report raised similar concerns about the role of the board in that process.
Yes.
And since becoming chair of the board, and particularly in light of the Prudential Inquiry, have you made changes to ensure that the board treats matters like the AUSTRAC matter with sufficient seriousness and holds management to account for addressing those matters in a rigorous and a timely fashion?
Yes, I have.
And can you explain the changes that you've made?
So starting with the quite extensive board renewal that we've undergone, so changing the way the board works, the way it challenges management, the reporting it gets from management. I also changed the rhythm of engagement with the CEO, so the chair to CEO relationship. In terms of the follow-through, we had work going on which we call our Big Rocks program, which included the development of a risks taxonomy, specifically in relation to non-financial risks. So there was the follow-through on that, and it becoming a part of the risk committee framework. So that brought non-financial risks into that framework quite explicitly. So they would be the key ones, just in terms of the actual style of the board and the questioning, and getting the experience onto the board of the people who understood risk management in financial services sector.
So you've changed the composition of the board. That's one of the things you've done?
Quite extensively. And also changed just in terms of the way the agendas are constructed for the meetings, and ensured there was actually more time. So as you've pointed out, there was, in terms of some of the meetings, there was very little time allocated for matters which are very important. And so we extended the time of both committee meetings and the board. And I changed the way the board operated in terms of its agenda so that it was quite clear what conversation was happening at any one time. So distinguishing the strategic conversations from the business operations conversations from the compliance conversations, to make sure that we were very focused on the accountability that we were addressing at any time as we worked through board meeting and the papers. And that's in addition to requesting improvements in the board papers themselves.
And how do you plan to assess the effectiveness of those changes that you've made?
Well, I think one of the things that we've done is really explore what governance is, what it actually means, and the frameworks through which the board exercises its governance duty, and then looking at those individual frameworks and assessing the health of those frameworks. So, for example, the risk management framework is one, the remuneration framework would be another. And on the risk management framework in particular, we spent a lot of time on the risk appetite statement. And in fact, we're just going through another cycle of updating that to make sure that the non-financial risks are clearly described, and the indicators that we have for each non-financial risk are those which will tell us whether that non-financial risk is in a state of control or outside of tolerance, but meaningful indicators, because we don't feel we've had sufficiently meaningful indicators in the past.
Are there other changes that you feel you need to make or would like to make?
Well, I think almost the complete change in the management team. Clearly, we've appointed a new CEO, and the CEO has almost a completely new management team, but there were two positions that are crucial in that management team. One is the Chief Risk Officer, and the new Chief Risk Officer has extensive experience in risk management in financial services, and is external, has come in as an external appointment. And the other one is the CIO, who also has extensive experience in financial services in the system side. So those two roles are actually pervasive across the whole organisation, and they bring with them very valuable experience, and experience that's additional, obviously, to the management team above and beyond what it had before. And I think Mr. Comyn spoke about the non-financial risk committee of management, and we now have to work with how that committee then links up and reports to the board. So that's the work that's going underway at the moment, which will actually improve the flow of information in relation to non-financial risks, because it will go through a management assessment, a management judgment, and management will then report that to the board. Up until now, the information has been coming almost unfiltered, if you like, and unfiltered in a collective view of the leadership team. And now we will have the collective view of the leadership team in relation to those non-financial risks.
Do you feel that the board now sufficiently holds management to account for addressing matters like the AUSTRAC matter?
Well, I think in relation to the AUSTRAC matter, I think that is the example of holding management to account. When it occurred, we took immediate action in terms of remuneration in relation to the item.
And just before you go on, when you say when it occurred, what are you referring
when the
to?
The AUSTRAC proceedings.
When the proceeding was launched by AUSTRAC,
yes.
You then did what?
We took immediate steps in relation to remuneration. So all senior executives forfeited their short-term variable remuneration in 100%. As you know, at that time also I announced that we'd been having conversations with the then CEO, and so in terms of his tenure, and so we began the search for a new CEO at that point, which started the process of renewal on the leadership team. And from that, I mean, clearly the degree of challenge at the board is significantly greater, and the non-acceptance of assurances in the sense of it's more of a show me, don't tell me. So we seek much more evidence of what actually has been done, and there's more urgency in terms of closure of the issues and less acceptance of long timeframes for closure.
And when did you reach your state of satisfaction that the board now holds management sufficiently to account for matters like the AUSTRAC matter?
Well, Ms. Orr, I don't think I'd say I've reached a state of satisfaction at all. But I think we could see, in terms of the extra disciplines that were put into the approach to board meetings, I think we saw that there was almost immediate improvement in the challenge to management and management's response. So that would be in the first half of 2017. And I think we've seen continuing improvement since that time.
All right. Now, I want to turn to the second of the three issues that I referred to some time ago. The second one being the way that the board and its committees are positioned to identify misconduct and compliance issues, having now dealt with an example of the way the board responded to a misconduct issue. Now, we've talked a little about that in the context of the AUSTRAC matter, but I want to ask you about the reporting that the board receives about customers. Do you understand?
I do.
And the Prudential Inquiry observed that the board received information about overall customer satisfaction, but that it did not receive any measures or analysis of customer complaints.
That's correct.
Now, we can have a look at some examples of the information that the board received about customers from a particular meeting, from the December 2017 meeting. That's CBA 0502 0001 8021. Now, if we could bring up the second page as well as the first page, we see the agenda for the first day of a meeting of the board on the 11th of December 2017. And the board received information about customers at this meeting in the management reports at item 5 of the agenda, is that right?
That's correct.
And in the group strategy progress review at item 8 of the agenda.
That's correct.
Now, if we go to paper 5.2, the management report from Retail Banking Services at 0093, we see that this is the management report from Retail Banking Services.
That's correct.
And if we turn to the second page, we see that it was presented by Mr. Comyn.
That's correct.
And I'll wait till that page comes up, but you'll see that item 3 deals with customer satisfaction performance.
Yes.
The information that the board got from Mr. Comyn was that CBA leads the major banks for the retail MFI Net Promoter Score in October, despite declining 0.2 to 1.1. NAB improved to second place on 0.2, Westpac declined to third place on negative 1.1, and ANZ remains in fourth place. CBA continues in first place for overall digital Net Promoter Score. CBA's mobile app achieved a record high score and has a margin of 10 points over NAB in second place. That was the information provided by Mr. Comyn as the head of Retail Banking Services about the customer experience for this board meeting.
Yes, that's correct.
Mr. Comyn reported about the customer experience by explaining how CBA compared to the other banks in its retail and digital Net Promoter Score.
That's correct.
And nothing was reported about customer complaints or any other poor customer experience?
No, and as the Prudential Inquiry pointed out, we focused far too much on customer satisfaction and good customer scores and not on dissatisfaction.
Well, if we turn to paper 5.7, we see the equivalent report from Wealth Management. That's at 0111. We see a single paragraph in the middle of the page about the customer experience in CBA's wealth business. You see that?
That's correct, yes I do.
Colonial First State continued to meet grade of service and customer experience survey targets in October. Complaints have also fallen. ComInsure met its GOS targets and CES for life offers. The general insurance CES was below target but improved to highest levels achieved this financial year. So again, the focus was on whether customer satisfaction levels had met CBA's targets.
Yes, that's correct.
And there was a reference to complaints having fallen, but nothing about those complaints.
That's right.
And the Prudential Inquiry, as you've observed, said that over the past 3 years, CBA's overall customer satisfaction ratings had been good.
That's correct.
But there were still customers who'd had very poor experiences with CBA, weren't there?
Yes, there were.
And CBA currently has about 16 million customers.
That's correct.
So even issues that affect only a small proportion of your customers still have the potential to affect a very significant number of people.
That's correct.
And complaints from CBA's customers, even a small proportion of those customers, may therefore be useful in identifying areas where CBA's staff are engaging in misconduct or conduct that falls below community standards.
That's correct.
Do you agree that it's important for the board to be informed about more than just overall customer satisfaction?
I do, and that is now the case, that we are informed.
So you agree that it's important for the board to understand what is happening when customers are having poor experiences with
Yes,
CBA?
I agree.
And did the other boards of which you were a member, such as the Telstra board, did they receive information about customer complaints?
Yes, in different ways, yes.
And prior to the Prudential Inquiry, did the CBA board ever receive reports on trends in customer complaints?
No, it didn't.
Did it ever receive reports analysing systemic issues observed in customer complaints?
No, not that I recall.
Did it ever receive information about specific customer complaints?
There might have been, and I certainly, as chair, received a lot of individual complaint letters.
In your capacity as chair, not
Yes.
because it came as part of
No,
the
no,
board papers?
in my capacity as chair.
All right. Now, do any of those things happen now? Does CBA now receive reports at the board level?
Yes, it does.
On trends in customer complaints?
Yes,
And does the CBA board receive reports analysing systemic issues observed in customer complaints?
yes, it does.
And information about specific complaints?
Yes, it does.
And when did each of those things start happening?
A few months ago,
In response to the Prudential Review?
yes.
And what does the board do now with the information that it receives about customer complaints?
So to the extent that the analysis leads to awareness of a systemic issue, so the question is asked, are there systemic issues from this? Or in individual complaints, seeks advice as to what has been done in relation to that complaint. But I would emphasise that we're in the early stages of getting this into a more sophisticated rhythm.
How do you, at the moment, based on the information you receive, assess whether these complaints represent systemic issues?
Well, the analysis would indicate whether there is a systemic issue, and management highlights that in the paper. There's provision for management to highlight that if that is the case.
that's something that management can now tell you about. Is that what you mean?
From the analysis of complaints. But as I say, it's in early stages of getting these systems really working in a more sophisticated way.
Even though it's in the early stages, has the information that the board's received about customer complaints allowed it so far to identify any emerging risks?
Not at this stage, other than the ones that are already known.
And should the board have been receiving and using this sort of information about customer complaints much earlier, in your view?
Yes, it should have been.
And what can you say about why it didn't?
I think as I've said, was too much assurance was taken from the customer satisfaction scores, and that wasn't triggering us to ask the question adequately about complaints, which we should have been asking. But we do now have this in place.
Could I tender that document, Commissioner?
Board papers for meeting of 11/12 December 17 of CBA 0502 0001 8021 Exhibit 7.32.
And the third aspect, Ms Livingstone...
Before we depart from this second aspect, Ms Orr, ultimately measuring things like culture, governance, outcomes presents a whole set of issues. I don't want to get down into particular details of it, at least not yet. But how important is it that the board be aware of a number of species of conduct? Can I give you all the species and then we'll come back? Intentional conduct, so the board being told of things where people have intentionally done something that they should not have. Unintentional behaviour, the careless, the silly. It's a human organisation, of course people do things carelessly, sometimes they behave in a silly fashion. Unintended consequences, that is the fact that something has led to a set of outcomes that no one intended, but that's what has happened either in a case or series of cases. And then what might be termed the opposite side of the ledger, the positive behaviour, the behaviour where the staff has done something that has gone well and truly beyond what they need to. How much of that is, and what kinds of behaviour are properly the concern of the board?
Well, I think all of them, Commissioner, not necessarily in the full completeness of every incident.
No.
But trying to get a feel for the centre of gravity of the organisation. If there are too many unintended consequences, that's a signal that something needs to be further investigated.
Well, it may tell you something, for example, about product design. It may not, but it may.
That's right. Certainly the board needs to know about every example of willful misconduct, and we get reporting of that, and whether it's directly known or whether it comes up through a whistleblower or through the Speak Up program, so we get reporting of that. And that has to be, virtually 100% what happens. On the positive behaviours, I think that's important to see, because it's important to know that they're acknowledged and recognised, and we would see that partly through the annual remuneration reviews, or there might be individual recognition that happens, or the CEO will comment, or a head of a business unit will comment on the positive behaviours. And we now have built into our remuneration system a specific element for the CEO to reward observed positive behaviours that go above and beyond what might be expected.
Yeah.
and those are communicated. And then you get I suppose the most difficult one to really track, which is the non-willful, inadvertent misconduct, if you like, not intentional, but misconduct nonetheless. And so that can come up through multiple points, but the board has to be sensitive to where that might be happening. For example, if there are audits in a particular area and there's a risk culture audit and it identifies those perhaps more minor issues, but if the weight of the minor issues starts accumulating, then you know you've got a much bigger issue.
Yes.
But the board has to be aware across all four of those that you described to different levels.
Yes, yes, Ms. Hall.
The third aspect of the governance and risk management arrangements at CBA that I said I wanted to ask you questions about, Ms. Livingstone, is the tone that the board sets in relation to the management and importance of misconduct and compliance issues. One criticism of CBA's board that was made in the Prudential Review was that the tone from the top in relation to the management of non-financial risks was unclear. Do you recall that?
Yes, I do recall that.
And can you explain what you understand the concept of tone from the top to refer to?
The tone from the top is the extent to which the board really indicates that it's interested in a particular topic, that it will regard matters in relation to that very seriously and will want management to respond very expeditiously. So that says to management that the board is taking this particular matter particularly seriously. Then there's the general tone from the top, which is the sense of urgency that you convey, the sense of integrity that you convey, the sense of non-negotiables that you convey, the intolerance for certain matters or behaviours that you convey. So it's how you call them out during a meeting from the papers in front of you, how you inspect a particular issue. That's all part of signalling the tone from the top.
Do you agree that the tone from the top has a significant influence on the culture of an organisation?
I do, and just to perhaps explore the culture concept, because I think so. The way we look at culture is made up of four elements, and one is obviously the people and the behavioural norms of the people. One is the processes in an organisation, then the policies, then the systems, because they're all interdependent. So the tone from the top can influence the behavioural norms, what's acceptable, what's not acceptable. It can influence the systems in the sense of investment in systems or not investment. It can influence the policies, as we have done, by requesting that there be a complete review of the policy framework and rewrite and simplification. The fact that the board has requested that to be done is part of signalling the tone from the top. Policies are really important, but they've got to be able to be complied with. And in fact, our policies now build in the link to the obligation, which gives rise to that policy. And then in the processes, the actual recognition that you have to have end-to-end processes. You can't have disconnected processes. Because people can have good intentions in an organisation, good behaviour, but if the processes and the policies and the systems are militating against them, then what you observe is a bad culture. But you have to drill down into what was the root cause of that bad culture observation. So, for example, if you take the AUSTRAC and the non-compliance, say, if I go to the SAFA and the non-lodgement of the TTRs,
The threshold transaction
Sorry, threshold
reports.
transaction report, sorry. So that, as the SAFA makes clear, there was no intent,
As the what makes clear?
sorry, the statement of agreed facts
In the federal court proceedings.
in the federal court proceedings.
Thank you.
There was no intent not to comply. So that's the behavioural side. But the process that failed, there were, in that particular issue, was a change management process, which led to the coding error in the system, which led to the non-submission of the threshold transaction reports. Now you stand back from that and you say that's a bad culture because that has ended up with a non-compliance. But what happened was the defects in the process and the systems in that particular instance led to a non-compliance. Now then there are other systems which should have come in to detect that non-compliance, and that's another issue. But in the first instance, you observe a bad culture because there is non-compliance. But there were contributory elements from interdependent elements in culture. So I know that's a bit complicated, but actually if you're trying to solve this problem, we have to go down to those elements.
Can I ask you to pan back for a moment, because the Prudential Inquiry made a number of findings about CBA's culture, very critical findings about CBA's culture. Do you accept that CBA needs to continue changing its culture?
Well, it does, and as you know, and I think from Mr. Comyn's evidence, for example, in terms of the behavioural norms, we now have a very clear code of conduct which establishes expectations that are linked to values, linked to the question of should we rather than can we, and then what you do if you have an issue, how you speak up and how you escalate it. So that is a very clear statement of the expectation of the behavioural norms in the culture, which was not there in as clear a way as it is now, for example.
What is the culture that you are striving to achieve at CBA?
So in terms of, I think one that certainly complies with our values as now stated, but one which is more disciplined in the way it basically goes about its business. Because unless we have that discipline, we can't possibly be assured that we are delivering good outcomes and good customer outcomes as well as good compliance in terms of regulatory compliance and to other stakeholders as well. So that lack of engine room discipline and rigour then led to other aspects of behaviour and business which then have an observed culture which is ill-disciplined and not focused on stakeholders, including good customer outcomes.
Can you give us an example of something that you have personally done to change the culture at CBA?
Well, I think I've personally led the renewal of the board. I've personally led the recruitment of a new chief executive. I've personally, in terms of the remedial action plan from, as required by APRA, I and two other board colleagues sat with the management team in terms of how that plan would be constructed, and very particularly how it would apply design principles, not rushing to the answer. Because the criticism of CBA has been that it's rushed to answers, the answers haven't been enduring, and the issues then turn up as repeat issues. So I was personally insistent that we take a design perspective in terms of that program. So think about the design of the solution before you implement, because you could have unintended consequences from competing designs. So actually I brought to that plan the perspective that I have had from my time in implantable medical devices, which is all about operational risk and compliance risk, how you go to root cause. I've been insistent that we drive to root cause. We have worked with issues. You can't work with issues, you can work with a root cause. We've had so many issues, we haven't been able to identify the systemic underlying root cause. Unless you've got a root cause mentality, you just see the issues. So I have been insistent that we get to root cause, that we have proper project management principles over the remedial action plan and being developed over the program of action. I've also raised the question of documentation, because unless you have good documentation, document what you do and do what you document, you can't be assured that you'll have repeatable processes without error. So these are perspectives that I personally have brought to the operations. I personally led the issue management standard design, because we have to take these issues and categorise them so that we know what we're dealing with. Are we dealing with a strategic issue? Are we dealing with a whole company-wide issue? Are we dealing with a business unit to business unit interdependency? Or are we dealing with an issue which can be resolved within one business unit? If we are, why can't that issue be resolved within 15 days or less? If it's a whole company-wide issue, all right, understand that might be a longer-term project, put it in a project, have project disciplines. But don't just record the issue and say 24 months' time it'll be done. That's not execution.
Do you agree that culture is a difficult thing to assess or measure?
I think it is, but once you break it down into those four elements and you start assessing it in terms of the behavioural norms, the conduct, whether we have effective policies, whether we have effective processes, and that comes back to your question on audit and assurance and controls. So that's the process, it's the assurance process by which we check whether we've got end-to-end processes. And the home buying, for example, in that APRA letter from October, the one element in that was called out for CBA was we were the one company that had actually done the end-to-end mapping of the home buying process, which is a crucial underpinning before you start talking about controls. And then you can look at your system's health, which comes back to the non-financial risks, and it's one of the elements in our risk appetite statement now, looking at the health of our systems, and that also follows the APRA IT review from 2016, as you would probably know.
In simple terms, Ms Livingstone, what do you want to see before you'll be satisfied that the culture at CBA has changed for the better?
I want to see that our code of conduct is actually lived, and I want to see that people are actually disciplined through the policy environment so they understand what it is they have to do and their duties, that we have people understand what process they're working in, and that we have systems that are all fit for purpose. And in all of that, I'd like to see more situational awareness.
Situational awareness? What do you mean by that?
So even if you're in a situation which is what you expect in your role and what you're doing, but if you become aware that something around you, either in what someone else is doing or what you've suddenly received, or it's just not right, something might be wrong, that you actually react immediately. You don't sort of think, I don't understand, but I won't worry about it, or that's someone else's problem, because it's that situational awareness which actually identifies issues right at their inception. And that is for everyone in the organisation. So that would be, could be in a branch with a teller, could be identifying that a particular customer is distressed. So why are they distressed? Perhaps it's a complaint and they haven't been able to articulate the complaint, and then so following up there immediately. Or if someone sees something going wrong in a system, something they didn't expect, that they raise it straight away, because their situational awareness says that's just not right.
How are you going to achieve situational awareness, Ms Livingstone?
Well, I think that might be our next phase of working through the organisation. But you asked me, when will I be happy? That's when I'll be happy.
And do you have a plan for how you're going to achieve situational awareness?
what we're doing at the moment is putting in place core frameworks that we're working on, and we're systematically putting them in place. We will have to check that they're all effective, whether it's remuneration or code of conduct or whatever. Once you've got those stable, then you can move and add more elements, but you can't put too much into an organisation at once, and particularly not one that has come through a very difficult time, is still in a very difficult time. There's a lot of change, there's new leadership, so you have to give an organisation time to absorb change, or the change doesn't become embedded.
Commissioner, if that's a convenient time.
Yes, how long do you expect to require?
Oh, I think I probably have another couple of hours with Ms Livingstone in the morning. It might be useful if we start at 9:45 again.
9:45? Can you be back here in time to begin at 9:45, please, Ms Livingstone? Very well, 9:45 tomorrow. Yes, Ms Orr.
Ms Livingstone, yesterday I asked you some
Sorry,
questions.
Miss Orr, sorry. I've just wondered, I had the opportunity to reflect overnight on my responses yesterday, and I feel I need to add to my response to the December 16 Audit Committee, and also my recollections of meetings between October and December 2016, if that would be possible.
Before you explain your reflections, have you been assisted in those reflections?
No, I have not.
Okay.
No.
But before you give them, to be clear, we provided you to review last night copies of minutes for each of 3 board meetings, one held on the 10th and 11th of October 2016, one held on the 8th of November 16, and another held on the 5th and 6th of December 2016. Did you review those minutes?
Yes, I did.
And they did not assist you?
They did to some extent, but that's why I would like to add to my responses. So, to the best of my recollection, it was at the October board meeting that I challenged management in relation to the AML CTF reports and the details in the regulatory report, and sought an understanding of AUSTRAC's perspective. I did not receive satisfactory answer to my challenge because it did not accord with my understanding of AUSTRAC. That response served to confirm the concern that I had been developing based on my experience as a non-executive director, that management at that time did not have the capacity to respond to what was clearly an escalating, significant and serious systemic control challenge. Management did not have the capacity either because they couldn't or they wouldn't. Later at that same meeting, and following what was the surprise and sudden decision of the former chairman that he wanted to resign from 31 December that year, I agreed to take on the role of chair of CBA. In making that decision, I understood very clearly that the degree of diligence that would be required from me would be greater than anything I had undertaken to date in my career, and that it would take years. So, turning to your question about the December Audit Committee meeting, and yes, you are correct, and as I agreed yesterday, I could have called for more detailed reports. My judgment as a director at that time was further questioning of that detail would serve little purpose at that time, because it would simply elicit further unsatisfactory answers. What was clear to me was that neither management nor internal audit could articulate the problem they were trying to solve, let alone identify the root cause of that problem. And unfortunately, that judgment was borne out by subsequent events. So in response to your very appropriate question as to what did I do in response to the AUSTRAC 167 notices, the AML red audits, the ASIC fees for no service report, the APRA op risk review, the APRA IT services review, and the largest no vote ever recorded at that point in time against a remuneration report in Australia in our November 16 AGM. So what did I do? What I did from the 1st of January 2017 is put my reputation on the line, take up the role of Chair of CBA and its responsibilities, but more importantly, its accountability for leading the fundamental change that had to be made in the way CBA operates. It's in that capacity as Chair and with that accountability that I appear before the Royal Commission today. And I do understand from your opening statement that you want to focus on what can be done to prevent the instances of misconduct which have come before the Commission. And I absolutely share that intent, and we touched yesterday on some of the actions I and we have taken at CBA. But I can assure you that the focus on changing the way CBA operates is central to what the board and the senior management team have on their agenda.
You heard from my opening, Ms Livingstone, that part of fixing these things going forward is understanding why things went wrong in the past. And I was exploring with you the board's role in relation to CBA's failings in the past.
That's correct, and I would endorse and have publicly and at the Royal Commission accepted all of the observations and recommendations in the APRA Prudential Inquiry. That is the most complete analysis of what went wrong and why things happened.
Well, it's one analysis of it. We're conducting another, Ms Livingstone, and if I may, I'd like to continue asking you some questions. The three documents that you reviewed overnight for those three board meetings in October, November and December of 2006, I want to take you to each of those briefly, starting with the October minutes. They are CBA 1004 0160 1335. Now, this is one of the documents you reviewed overnight, Ms Livingstone, the minutes of the board for the meeting on the 10th and 11th of October 2016. These are the minutes, Ms Livingstone.
Yes, they are.
And if we turn to the last page, 1351, we see that these minutes were signed by the Chair, Mr Turner. The signature's been redacted, but you know that is Mr Turner's signature there.
I presume it is, yes.
And they were recorded in the minute book. We see that there.
Yes.
And immediately above this part of the minutes, we see that in a director private session, the directors met privately and discussed chairman's succession, which included a presentation by you.
That's correct.
And what did that presentation involve, Ms Livingstone?
That presentation involved my view on how I would conduct the board if I were invited to be chair, and what I saw as had to happen in CBA to address the various issues that we've been through today and yesterday.
Were you the only candidate to succeed Mr Turner as chair?
At that point, I was, yes.
Now, if we turn to page 8 in the minutes, which is 1342, we see a reference towards the bottom of the page to a regulatory report being considered at this meeting. This is the regulatory... I'm sorry.
It's not coming up on my screen.
Perhaps if we could have the entirety of the section under regulatory report on the screen. Now, this is the meeting at which you say today you challenged management. Is that right?
To the best of my recollection, it was this meeting.
Yes. And what allowed you, Ms Livingstone, what allowed you overnight to come to the certainty that this was the meeting at which you challenged?
Because I went through my recollection. I know the circumstances of the particular boardroom. It could not have been the November meeting because we were in Perth. And my recollection of the timing of my challenge versus the discussion on when I would become chair was that it was coincident.
This will come up on the screen, Ms Livingstone, but you reviewed this document overnight, and I'll read the relevant portion to you under the heading Regulatory Report. Cassandra Williams and Gary Dingley presented the regulatory report. Matters discussed included ASIC notices received during the period, ComSec fines and APRA's activities, including the upcoming review of ES, which will focus on IT strategy and infrastructure resiliency. It was noted that the group had responded to the AUSTRAC statutory notices and there had been no further correspondence to date.
I'm familiar with the section.
And the final line is, the board discussed and noted the report. We now have it on the screen, Ms Livingstone.
Yes.
So you see that there is no reference to any director challenging management about the content of that report.
I note that there isn't, but that does not mean that I didn't. In fact, I did, and I received a response.
There's no reference to management providing any assurances to you about the reasons why CBA was receiving these statutory notices from AUSTRAC.
It is not necessarily the case that the minutes record every single conversation that occurs during the board, but I can assure you, Ms Orr, I asked the question and I received the response.
Should they, Ms Livingstone? This is the official record of the minutes of a meeting of the board of CBA at which very significant matters were discussed. If you challenged the regulatory report and were provided with assurances by management in response to that challenge, should they appear in this official record of that meeting?
Ms Orr, it's not possible for minutes to record every single question in a board meeting, and most of the questions are in fact very serious questions. That is the purpose of the board meeting.
Well, is that satisfactory, Ms Livingstone? CBA has a statutory obligation under the Corporations Act to keep minute books. You're aware of that?
I am.
And the minute books must record proceedings and resolutions of meetings of directors.
And in this case they do, but they don't record every single question that a director asks.
Well, do you accept that they don't record a very significant exchange that you say occurred at this meeting, but which we have no record of?
I do accept that, but I am also aware that I'm giving evidence under oath.
Yes, and I'm asking you about the adequacy of these minutes, Ms Livingstone.
In terms of reflecting that particular exchange, no, they do not reflect that exchange, but that exchange did occur, as did many other exchanges during the meeting, which would not be reflected verbatim in the minutes.
Is that good enough, Ms Livingstone?
Well, the minutes of the meeting already run to... Now, we have actually expanded our minute taking, and the minute taking is significantly improved, but they do actually run to about 30 pages.
About how many pages?
About 30 pages.
Which minutes run to about 30 pages?
The minutes that we currently take
Right.
for board meetings. As I said, we have improved Since I took over as chair, we have improved our minute taking.
And these minutes run to about 17 pages, you've seen that?
Yes, I have.
And do you understand that a failure to comply with the requirements in relation to the keeping of minutes under section 251A of the Corporations Act is an offence?
I am, but these are the minutes of the meeting. And I assert again that I asked the question and received the response.
Yes, and you can offer no explanation for why that is not recorded in these minutes.
The explanation is that the minutes don't usually record verbatim what is discussed at the board meeting.
And I'm not expecting the minutes to record verbatim what was discussed, Ms Livingstone. The keeping of accurate minutes of the board of an organisation like CBA is very important because those minutes are the evidence of the matters that are discussed in the meeting.
I understand that, Miss Orr.
Is it CBA's practice at each meeting of the board to put a resolution to adopt the minutes of the previous meeting?
Yes, it is.
And that occurred in relation to these minutes?
It would have, yes.
Yes. All right. I tender those minutes, Commissioner.
CBA October board, October 16, is it?
Yes, it is,
CBA
Commissioner.
October 2016 board minutes, CBA 1004 0160 1335, Exhibit 7.33.
Now, for completeness, Ms Livingstone, I'd like you to identify, and I'll tender the minutes of the board meetings on the 8th of November and the 5th and 6th of December. I understand from your evidence this morning that you don't assert that you challenged management in either of those meetings about AUSTRAC.
I may have in terms of the conversation around the regulatory report, but the particular exchange that I am recalling where I received assurances from management which I did not feel comfortable with, and from senior management, not middle management, is that particular meeting that we've just discussed.
All right. Could I ask you to identify CBA 1004 0160 1446, the minutes of the meeting on the 8th of November 2016? There we have them, Ms Livingstone. These are the minutes of the meeting held in Perth on the 8th of November 2016.
Yes, that's correct.
I'll tender those minutes, Commissioner.
CBA November 16 board minutes, CBA 1004 0160 1446, Exhibit 7.34.
And it was following this meeting, Ms Livingstone, that the board resolved to appoint you as chair. Is that right?
No, that's not correct. I think it was resolved by circular resolution after the previous meeting.
All right.
And
Well,
I think you'll see on the bottom of that page, there was a 12th of October circular resolution.
I see. So we see recorded in these minutes the resolution from the 12th of October to appoint you as chair.
That's correct.
Thank you. All right, could I ask you to identify CBA 1004 0160 1319? These are the minutes of the meeting of the board on the 5th and 6th of December 2016.
Yes,
And you've reviewed these minutes as well.
that's correct.
In these minutes, as with the previous 2 minutes, there's no record of any challenge by any of the directors to management about the AUSTRAC matters.
No, other than if I could see the section on the regulatory report, please.
Yes, 1325 to 1326.
If I could see the full section, thank you. It's recorded there the board did discuss and note the regulatory report.
Yes, and what I asked you, Ms Livingstone, is whether there was any record in these minutes or the previous set of minutes of any challenge by a member of the board to management about their handling of the AUSTRAC matters.
Not as noted in the minutes, no.
Thank you. I'll tender that document, Commissioner.
CBA December 16 board minutes, CBA 1004 0160 1319, Exhibit 7.35.
Ms Livingstone, I understood you to say in your answer before that you didn't seek any of the red audit reports in relation to the AUSTRAC matters because you didn't think there was any point to doing that. Is that right?
There was no point, at that time, to drilling down into further detail because management could not respond. They could not articulate the problem nor the root cause. At that time, so that is towards the end of 2016, and I was going to take up the role of chair from the 1st of January 17. My intention was from January 17, when I was in the role of chair, that I would be in a position to take action.
So you had a significant lack of faith not only in management but in the audit team as well. You weren't interested in the detail of their audit report about the failings.
I did not say that I was not interested. I said that the audit report, neither the auditor nor management could articulate what the problem was and hence what the root cause was. They could identify the symptoms.
How do you know that, Ms Livingstone, when you didn't ask for the audit report? You don't know how the audit team articulated the nature of the problems.
I did know from the discussion that we had at the board meeting and their responses at the audit committee meeting.
The best way of understanding that would have been to review the audit report, wouldn't it?
No, I think the best way is actually to interrogate the people who write the reports to see whether they have the understanding rather than what is actually written in the reports.
And we see no reflection of any interrogation to that effect in any of these discussions.
That doesn't mean it didn't happen.
I see. Now, I want to move on from these documents, Ms Livingstone, and return to the topic that we were discussing yesterday, which was cultural change at CBA.
Yes.
Do you accept that part of the necessary cultural change at CBA is an improvement in CBA's relationships with regulators?
Yes, I do, and we have been, as you know, resetting our relationship with regulators.
And not long after you became chair of the board, you requested a meeting with Mr Medcraft, who was then the chair of ASIC.
I think actually it went because Mr Medcraft was handing over to Mr Shipton, and so the meeting, I think...
After you became chair of the board?
No, sorry. No, I've got the wrong year. No, sorry. I did request a meeting with Mr Medcraft, sorry.
And why did you do that? Why did you request a meeting with the chair of ASIC after you became chair of the board?
I requested a meeting with the chairs of all of the regulators that we deal with regularly, so AUSTRAC, ASIC and APRA.
Why, Ms Livingstone?
Because I think it's very important that the chair, on behalf of the board, has a direct relationship with the regulator so that the regulator can hear from the chair and the chair can hear directly from the regulator what the regulator's views and concerns are.
So important to have a direct relationship so you can hear from each other, is that right?
That's correct.
And what do you envisage that the chair of ASIC should hear from you as the chair of CBA?
Well, as we've discussed in terms of the matters that were on foot, the chair of ASIC would want to know what the board is doing about those matters and how the board is working with management to address those matters.
Matters that are on foot, what do you mean by that?
The matters on foot with ASIC or with any regulator.
Do you mean matters that are under investigation by ASIC?
No, not necessarily. No, matters that are of concern or industry-wide matters. So, for example, in my first meeting with Mr Medcraft, we discussed the role of proxy advisors as an example.
Did you have a set of things that you wanted to discuss with Mr Medcraft in preparation for that meeting with him?
A chair, when you go to meet a regulator, is always provided with a briefing note so that you're aware of background.
So what did you hope to achieve from that meeting with Mr Medcraft?
It was an introductory meeting in context of my coming into the role as chair, so it was courtesy in the first instance and to discuss matters that he might have on his mind.
And what did he tell you he had on his mind?
I think if I recall my notes from that meeting, there would be the relationship between ASIC and CBA and the concerns, as we've heard, that it was not always as cooperative as it should have been. And I'm paraphrasing here, but that it was legalistic and defensive.
Anything else that he had on his mind that he shared with you in that meeting?
I can't recall specifically.
Now, not long after Mr Shipton became the chair of ASIC earlier this year, you had a meeting with him too?
Yes, I did.
And what was the purpose of that meeting?
Again, that was courtesy because he was just coming into the role. So I met with him to introduce myself as chair, and we had a very good discussion in terms of his perspectives on markets and market integrity, and we discussed the importance for financial services in having more exposure to other industries and understanding what other industries, the approaches they took to operational risk in particular. And he was interested in my experience from implantable medical devices in that regard.
Were there other things that you raised with him?
I think it was more along the lines, because we discussed the importance of a cooperative relationship and the fact that it was a mutual responsibility between regulators and the organisations in the financial services sector to ensure that there was trust in the sector.
Do you have regular meetings with the chair of ASIC, Ms Livingstone?
Probably, well, definitely the board meets once a year, and I make it a practice to meet one-on-one with the chair of a regulator once a year, if that hasn't already happened in the course of the year.
And do you ever discuss investigations that are underway in those meetings?
No, not usually, because they don't want to discuss investigations specifically.
What about any enforcement action that's been taken? Do you discuss that in those meetings?
Only after the event, usually. So, for example, with APRA, we might discuss the progress on the enforceable undertaking in terms of the remedial action plan or the remuneration consequences, for example.
So you have regular meetings with APRA too?
Yes, I do.
And what do you discuss in your meetings with the prudential regulator?
A whole range of matters, ranging from the views on culture, on remuneration, very specifically. We have an annual chairs meeting, which is chair of board, audit committee and risk committee. And for example, the targeted review that's been mentioned here at the Commission, we had a chairs meeting and discussed that in detail. With Mr Byers, of course, I've kept him informed as we've gone through the process of looking for a new CEO, and then the eventual appointment of a new CEO. I also, in accordance with the BEAR regime, will advise Mr Byers if we're considering appointing a new director after we've put that director through the fit and proper process. There's a 14-day notice period, so I will personally contact Mr Byers when we put in that submission.
Now, the board of CBA met with Mr Byers in February this year.
That's correct.
And following that meeting, you wrote Mr Byers a letter?
Yes, I did.
I'd like to show you that letter, which is APRA 0061 0001 2508. This is the letter that you sent to Mr Byers on the 16th of February this year, Ms Livingstone.
That's correct.
And in the first paragraph you said, "Thank you again for the frank and valuable discussion with the CBA board on the 5th of February 2018. Having reflected with the board on the matters raised, I thought it would be useful to follow up with our thoughts on and give an indication of CBA's approach to those matters."
Yes.
And you went on to say, "The board acknowledges and shares your desire that CBA take a leadership position in the industry to promote higher responsible lending standards. We recognise the influence of CBA's significant market position in home lending and other sectors." That was what you said to Mr Byers?
Yes.
So what changes is CBA planning to make to promote responsible lending?
That particular comment came out of the macroprudential requirements at that time, but we also discussed the targeted review and the progress on the implementation of the recommendations of the targeted review.
I understand that, Ms Livingstone, but I'm referring to the sentence here where you said the board acknowledges and shares your desire that CBA take a leadership position in the industry to promote higher responsible lending standards. What are you planning to do in your industry-leading position to promote higher responsible lending standards?
Well, as you probably, excuse me, as you probably know from the evidence of Mr Comyn, one of the main things that we have done is improve the detail that we receive on borrowers' expenditure patterns, and we've increased the number of elements that we put in to that analysis from a single line to 11 items. We have also increased our analysis of other financial institution potential borrowings by customers. We've invested $100 million in our home lending platform. We have increased the analysis through what we call our command centre to identify patterns within our home lending process. This is part of operational risk control. And we've improved our analysis of customer outflows to identify any unusual outflows that may not have been declared by customers. We have also reduced and are reducing our reliance on HEM. And in fact, I wrote to Mr Byers on the 29th of October this year, indicating that we would bring our reliance on HEM down to below 60% by December this year. So they're some of the actions that we're taking to ensure that we are actually reflecting what's expected of us in terms of a leadership position.
Well, why didn't you take a leadership position on those changes earlier?
We have been taking a leadership position since that time. I think Mr Comyn had reflected the point in his evidence that it was disappointing that the targeted review had to identify matters which we had not self-identified, but the review having identified them, we have acted on them expeditiously.
In the next paragraph of this letter, you refer to Mr Comyn as the incoming CEO. I'll just wait till it comes onto the screen. Do you need that blown up, or can you read the paragraph starting with "more is needed of us," Ms Livingstone? Yep. Mr Comyn, as the incoming CEO, will arrange to meet you to discuss ways in which CBA can increase its leadership role in the industry. Do you see that?
Yes, I do.
Now, Ms Livingstone, given its history and its position in the market, do you think that CBA has a responsibility to lead the industry in making changes that are the right thing to do, even where there might be a first mover disadvantage?
I think this issue is canvassed with Mr Comyn, and in the context of a first mover disadvantage, and if you're referring to mortgage brokers in particular.
I'm not. I'm referring to this statement in this letter, and I'm interested in your views, not Mr Comyn's views, Ms Livingstone.
Certainly. So to the extent that a first mover would actually affect the industry as a whole and the standards in the industry as a whole, yes, it would be appropriate for us to take it. To the extent that we might take action and there be no impact on the industry as a whole, then I think we would question and would want to work with the regulator.
Are there other areas apart from responsible lending standards where you think it's appropriate for CBA to take the lead?
I think in everything we do, we should be seen to have leadership standards.
Within the industry?
And more broadly.
What do you mean by more broadly, Ms Livingstone?
Well, for example, our corporate governance standards. We have taken a particular lead, and you might have seen from our annual report that in terms of our disclosures under the Task Force for climate-related financial disclosures. We have taken a lead there. We have taken a lead in our approach to disclosure matters generally. So that's what I mean by corporate governance.
Are you doing enough to take the lead in the industry as CBA?
We can always do more, but we're doing as much as we can, as fast as we can.
A few pages over in this letter, at 2510, you said to Mr Byers in the paragraph above the heading CBA Perspective, finally, as noted at our meeting, a prerequisite for the effectiveness of governance is a strong working relationship between board and management. The board has a duty to inquire and interrogate. Management has a duty to inform and disclose, and these two aspects must result in a meeting of the minds. This contextual aspect of governance is receiving explicit attention. That was what you said to Mr Byers?
That's correct.
And reflecting on the period prior to the prudential inquiry, do you think that the board failed in its duty to inquire and interrogate?
I think it is correct to say that there was not enough challenge, and that would be through inquiring and interrogating, of particular matters.
Yes. So the board did fail in its duty to inquire and interrogate?
It didn't adequately address the duty, yes.
And do you think that management failed in its duty to inform and disclose?
Yes, I think that's correct.
And how is this aspect of governance, as you describe it, now receiving explicit attention at CBA?
Because it relates to the relationship between the chair and the CEO, and that's a very important relationship and a continuous conversation between the two, so that management can alert the chair as to matters which might be useful to inform the board and more serious matters to disclose. And similarly, the chair can inform through the CEO what the board considers important matters where it would like to inquire and more serious matters where it would like to interrogate. And that is the process by which the agenda for the meetings is determined, and the matters on the agenda and the time allocated to those matters in the agenda.
Now, if we go back one page finally in this letter to 2509, you said to Mr Byers under the heading Frameworks, your challenge to us that the answer to effective board oversight is not simply a matter of directors meeting for longer and working harder was most apposite. As you observed, what is needed are frameworks that enable directors to form a view of current risk issues and to anticipate emerging issues. And underneath that, you listed a number of frameworks. And the first in that list of frameworks, the first dot point, is the remuneration framework. Do you see that, Ms Livingstone?
That's correct.
And you described the remuneration framework as being crucial across multiple dimensions, and you said it was receiving intense scrutiny from the board.
That's correct.
What did you mean when you said that the operation of the remuneration framework was crucial across multiple dimensions?
Because we discussed the dimensions of governance and looking at effectively starting with the OECD definition of governance. Governance is about direction, control and people. And remuneration frameworks operate across direction, so that is long-term remuneration, control, that is short-term remuneration, and people generally, which is making sure that they are appropriately paid and that the remuneration framework applies consequences, both negative and positive.
Do you agree that poorly designed remuneration structures can be a driver of misconduct and of poor risk management?
If they're poorly designed, and even if they're well designed, but not accompanied by other frameworks, being checks and balances, they may still have inherent risks.
And do you think that by contrast, well-designed remuneration structures can be a useful tool to promote good risk management and reduce the risk of misconduct?
I do.
I'll tender this letter, Commissioner.
Letter of Livingstone to Byers, 16 February 2018, APRA 0061 0001 2508, Exhibit 7.36.
Now, Ms Livingstone, that brings me to the next topic that I want to ask you about, which is your role as a member of the Remuneration Committee. And you said yesterday that the Remuneration Committee oversees the bank's remuneration policy.
Yes.
And it makes recommendations to the board about the remuneration of the CEO and the senior executives each year.
Yes.
And now I asked Mr Comyn about some of the decisions that CBA has made about the way it remunerates the bulk of its employees. And what I want to ask you about are the decisions that the board makes about the way it remunerates the organisation's executives.
Yes.
And in particular, I want to ask you about the decisions that the Remuneration Committee made and the board made about the remuneration of those executives in the 2016, 17 and 18 financial years.
Yes.
Now, before I do that, I just want to make sure that I understand in general terms how executives are remunerated at CBA. And Mr Comyn explained to us that most of CBA's employees have two components to their remuneration. They have fixed remuneration and they have variable remuneration. That's broadly true for executives as well?
That's correct.
But at CBA, the most senior executives, the CEO and the group executives, receive two different types of variable remuneration. Short-term variable remuneration and long-term variable remuneration. Is that right?
That's correct.
Now, it might assist if I bring up a copy of CBA's remuneration report from this year, which sets some of this out. If we could bring up RCD 0021 0028 0196. This is the 2018 annual report for CBA, and could we turn to 0300 in the remuneration report? About halfway down the page, we see the three different components of group executive remuneration. On the left, we see under FR fixed remuneration. Perhaps if we could bring that part of the document up. I'm sorry, if we could bring up the full table there with FR, STVR. Thank you. So on the left we have fixed remuneration. In the middle we have short-term variable remuneration, which is essentially an annual bonus.
We don't regard it as a bonus. The variable remuneration is actually part of total remuneration.
Okay. And at the end of each year, the board determines how much each executive will receive as their short-term variable remuneration.
Yes, it does.
And that can range, we see from this, between 0 and 150% of the fixed remuneration.
That's correct.
And half of that we see from this is paid in cash straight away.
Yes.
And the other half is paid in shares.
That's correct.
But the shares are not paid immediately.
No, they're deferred for 2 years.
Yes.
Or over 1 and 2 years.
So the executive gets half of the shares 1 year later and the other half 2 years later.
That's correct.
Why does CBA do that?
The deferral mechanism is important, as you know, for ensuring that the short-term variable remuneration, and it applies in the long-term variable remuneration, has been awarded in relation to circumstances that are fully understood. So if matters come to light subsequently, the deferred remuneration can be reduced or forfeited completely.
Mm-hmm. Now, before I move to the third component, the long-term variable remuneration, I just want to put some propositions to you in broad terms to understand how the board makes decisions about how much short-term variable remuneration each executive receives. As I understand it, but correct me if I'm wrong about this, the Chief Risk Officer reports to the Risk Committee about any risk issues that might affect the remuneration of executives.
That's correct.
And that information is also provided to the Remuneration Committee?
is provided to the Remuneration Committee, and it's done on the basis of a detailed risk scorecard for the individual.
It is at this stage. It hasn't always been done that way.
No, it hasn't. And as you know, we have been improving our remuneration framework every year from 17, 18, and we continue to work on our framework.
So the Chief Risk Officer reports about risk issues, and the CEO also reports to the Remuneration Committee about executive performance.
Does, and the Audit Committee also reports about control issues
Yes.
that have arisen in the executives area, but those control issues are also picked up on the risk scorecard under one of the 4 quadrants which relates to issues and incidents.
The CEO makes a recommendation to the Remuneration Committee about the executive remuneration outcomes,
Yes, he does.
and having received information about the risk issues that might affect the remuneration and about the performance of the executives and the audit matters that you've identified, the Remuneration Committee then makes a recommendation to the board about whether the remuneration of each executive, about how much remuneration of each executive should be provided.
That's correct.
So they decide whether they should receive their short-term variable remuneration, and if so, in what amount.
That's correct.
And the board then makes the final decision about how each executive should be remunerated, including whether they get that short-term variable remuneration.
Yes, they do, and the board reserves its right in relation to the deferred remuneration to exercise discretion at a future date if necessary.
Then if we come back to the third component, in the right-hand column, that's long-term variable remuneration.
That's correct.
At the end of each year, each executive is allocated a certain number of reward rights.
Well, it's actually at the beginning of the new year.
I see. And 4 years later, depending on certain criteria, which I'll come back to, the board makes a decision about whether those reward rights vest, that is, whether they're converted into shares.
That's correct.
Now, if we could go back so that we can look at what appears under this table and blow up the part entitled CEO and Group Executive Remuneration Mix. We see references there to target short-term variable remuneration and maximum short-term variable remuneration. Could you explain those concepts, Ms Livingstone?
The target is, as you can see there, defined as 100% of fixed remuneration, and the maximum is obviously the 150%.
Mm-hmm. And if we look at the target diagram, we can see that 26% is fixed remuneration, which they're guaranteed to receive each year.
That's correct.
And a total of 26% is short-term variable remuneration, and the board decides how much of that they'll get.
That's correct.
And 48% is long-term variable remuneration, which they might get 4 years later, depending on whether they've met the criteria.
That's right, because that is actually on that table included at its maximum value, which is 180% of fixed rem.
Ms Livingstone, why does CBA pay its executives any variable remuneration? Why not just pay them an appropriate salary?
The total remuneration, which is split between fixed and variable, has very specific purposes attached to the variable part. They start with the ability to have what we call a balanced scorecard, which indicates very clearly to executives that we expect balanced outcomes across financial outcomes, customer outcomes, people and strategy. The second thing it does is through that scorecard enables us to highlight priorities, as we have done for the FY19 year. As you know, in the scorecards, APRA required us to give priority to the remedial action plan, and all senior executives have a 30% element in their scorecard for that. The third thing it enables us to do is to ensure alignment with the risk management framework, which is why we have those risk scorecards as a modifier to remuneration. It also enables us to discriminate between executives who might be at the same fixed remuneration level but have different levels of performance. Because, as you might know, internal equity in terms of remuneration is as important to employees as benchmarking to market. Perceived lack of internal equity has a very damaging effect. Finally, we need the short-term remuneration and the long-term, in terms of its deferred part, to deliver consequences where that's necessary.
Now, I want to ask you, Ms Livingstone, why you can't achieve those objectives with an appropriate fixed salary and a consequence management framework and a promotion and reward framework. You talked about achieving balanced outcomes, highlighting priorities, ensuring alignment with the risk management framework. Why can't you achieve those objectives in the way I've suggested?
Because a one element, fixed remuneration, does not give you the discrimination that having a variable component does. So, for example, we might have 3 executives who are on the same fixed remuneration, and you'll see from the remuneration report that they generally are on a similar level for similar responsibility. But to the extent that their performance differs, some perform better than others, we want to be able to reflect that in remuneration. If it were one fixed sum, we could not do that. And the elements of promotion and those other factors are very important mechanisms as well, and they are part of the framework, but they work in conjunction with the remuneration system.
Do you think there's a perception among executives that unless they do something wrong, they should get their short-term variable remuneration? That is, they should get it for doing their jobs.
I would argue, if you look at the results for FY17 and FY18, no executive in CBA would think that they would get their short-term variable remuneration just for doing their job.
Well, I said unless they do something wrong, because the consequences that you imposed, particularly in FY17, were as a result of them doing something wrong, weren't they, Ms Livingstone?
That's correct, but if you look at FY18, the question of someone doing something wrong or not doing something adequately gets reflected in the short-term variable remuneration. So they don't have to do something wrong to have a consequence in their remuneration.
Do you think the purpose of variable remuneration has changed over time?
I think we have made it very explicit in our framework in terms of the balanced scorecard risk side as well as the consequence side. But I do think, and we are struggling with this, we are currently looking at our remuneration framework as we evolve it still further, what the appropriate approach to short-term and long-term is, whether you can have the one element, but we've seen in the market that there are issues with these so-called hybrid remuneration schemes. They have unintended consequences. They have some good features, but they have unintended consequences as well. So we are actually consulting quite widely and getting advice and looking internationally at the experience as to how you could have one of these hybrid schemes that enables you to defer remuneration so that you can apply discretion years after the remuneration is awarded. And you would know from the FSB supplementary principles from 2015 and the PRA from 2016 and APRA's 2018 report that the concept of deferral is something that's supported by most regulatory authorities. So how to best achieve that deferral without front-end loading, if you like, with an emphasis on the short term, but also make sure that it is sufficiently meaningful to executives that they value it. And one of the problems with long-term variable remuneration, because it often doesn't vest, is that executives don't attribute value to it, in which case it is valueless both to the board and to the executive.
You say that you're considering these things, consulting, working through the best way to deal with these issues. Are you aware of the changes that NAB is making in its remuneration framework?
We have been looking at NAB and we have been looking at ANZ, but that's part of the mix that we are.
And what are your views about their remuneration frameworks? Do they achieve the things you are trying to achieve?
Well, I don't necessarily want to be critical of others, but we think there are potentially unintended consequences in the mix. And the other issue for us is maintaining consistency and stability in the remuneration framework, because that is also important to employees if they think it's going to change every year.
What are the unintended consequences that you say are in the mix?
There's potentially too much focus, or could be, depending on how you design it, on rewarding outcomes in the current year. So that has the risk of rewarding short-term performance and distracting from focus on the longer term. That's our biggest conundrum at the moment, how you can be sure that you're adequately keeping focus on the long term while also have the intensity of focus on the short term. It's getting that mix.
In circumstances where, as you've acknowledged, long-term variable remuneration frequently doesn't vest and is therefore not valued by executives.
In the structure that we have at the moment. Now, another structure is that you award performance rights in 1 year and they stay on foot over a long-term deferral, could be 5, could be 7, could be 10 years. And there's no performance hurdle involved other than the effluxion of time and the exercise of discretion if circumstances change, but absent that, the executive would get them at the end of the period. That's one model. Another model is to have a hurdle at the beginning and a retest hurdle at the end. To executives, that can be seen as a double jeopardy. So there's a hurdle at the beginning, but then they don't value because they don't know what the hurdle at the end is going to be like, which is the situation that we have with our long-term variable remuneration. So as you would know from the FY15 plan that just vested, 75% of it did not vest because of the financial outcomes were not achieved. So the overall vesting was around 24%. In other years it's been 20%, other years 67%.
I'll come back to the vesting of long-term variable remuneration. Could I for now tender the 2018 annual report?
CBA 2018 annual report, RCD 0021 0028 0196, exhibit 7.37.
Ms Livingstone, you've told us that you became a member of the Remuneration Committee in January last year when you became chair of the board.
That's correct.
And CBA's financial year runs from the 1st of July to the 30th of June.
Correct.
And that means that you joined the Remuneration Committee halfway through the 2017 financial year.
Correct.
But you were on the board at the end of the 2016 financial year.
I was.
And you were therefore on the board when it approved the remuneration outcomes for CBA executives for the 2016 financial year.
Yes.
Now, CBA released its 2016 remuneration report in August 2016.
Yes.
And by that time, the ASIC and APRA investigations into CBA's life insurance business were ongoing following the media reports about Comyn in March 2016.
That's correct.
And by this time, CBA was aware of a number of other issues that became public over the course of the following year. Do you agree with that?
Yes, I do.
And they included the anti-money laundering and counter-terrorism financing issues.
Yes.
They included the charging of fees to customers for a service that hadn't been provided.
That's correct.
And they included the mis-selling of credit card insurance, which I asked Mr Comyn about.
Yes.
but those failings weren't yet known to the public at the time that the remuneration report was released in August 2016.
Yes.
Now, could I take you to that remuneration report, which is RCD 0021 0028 0001? Now, the remuneration report for 2016 begins at 0049 in this document. The chair of the Remuneration Committee that year was David Higgins, Ms Livingstone.
That's correct.
And we see on this page his message on the front of the remuneration report. And
Yes.
do you see in the first column, about halfway down, there's a reference to the concerns raised in the media about Comyn. Do you see that reference?
That's correct.
But there's no reference to any of the other issues that I've identified that were known to the bank. Nothing about the failings in relation to anti-money laundering measures, nothing about charging fees for no service, nothing about mis-selling consumer credit card insurance.
That's correct.
Now, I want to take you to some of the documents that show how those matters were taken into account in determining how much money would be paid to CBA executives that year. Now, you said earlier that one of the matters that's taken into account in that process is the Chief Risk Officer's views about risk issues.
Yes, but Ms Orr, can I just make an overall comment in relation to the outcomes for 2016?
Well, I want to take you through the sequence of those outcomes and how they were arrived at, Ms Livingstone. Could we do that? And if you need to make some observations at the end of that process, I'm happy for you to do that. But I want to do this by showing you the documents that record each of the stages.
Which will show that it was inadequate.
Yes.
Yes.
All right, well, we'll accept at the outset that it was inadequate. And can I show you the documents to understand the process that led to it being significantly inadequate? Do you agree with that characterisation,
I do.
Ms Livingstone?
I do.
All right.
And my fellow directors would also agree with that.
All right. Well, let's look at how that played out, Ms Livingstone. Can I ask you to look at, I'll tender this annual report, Commissioner.
CBA Annual Report 2016, RCD 0021 0028 0001, Exhibit 7.38.
Could we turn to CBA 1004 0041 1992? So this is the agenda for the meeting of the Remuneration Committee on the 5th of August 2016.
Yes.
And you weren't present at that meeting, Ms Livingstone, but you've reviewed this document in preparing to give evidence.
Yes, I think I have.
And at the meeting, the Remuneration Committee considered a paper called Risk Considerations for CEO and Group Executive Remuneration. That's at 1997. We see that that was a paper prepared by Mr Cohen, the Group Chief Risk Officer, and Ms Linklater, the Executive General Manager of Performance and Reward.
Yes.
And its purpose, as described in 1.1, was to provide support to the Risk Committee concerning the risk behaviours demonstrated by the CEO and the Group Executives in the 12 months to the 30th of June 2016.
Yes.
You see that? And under background facts at 3.2, the report said, the Risk Committee advises the Board's Remuneration Committee on the appropriate risk factors that warrant consideration when assessing the performance of executives.
Yes.
Was there anything more to the process of advising the Remuneration Committee on the risk factors that warranted consideration for executive remuneration other than this paper being considered by the Remuneration Committee?
At that time, I think this was the only paper that was considered.
And the first attachment to this paper is at 1998. That's a letter from Mr Cohen to the Risk Committee. Mr Cohen said, this letter is provided as input into the assessment of the recommended STI outcome for the CEO and group executives. It supports the Risk Committee's comments to the Remuneration Committee about any risk matters of concern, including risk behaviours, which require consideration in determining the following. And that's all referable to the short-term variable remuneration. Second paragraph. In summary, for the financial year ended 30 June 2016, I do not believe there to be any risk issues or risk behaviours that would suggest STI awards should be modified from that recommended based on other achievements or results. However, as always, there may need to be adjustments yet to be determined for FY 2016 due to potentially subpar compliance and other matters currently under investigation. One such matter is the Comyn issue, which, although still under investigation, the Risk Committee may wish to consider separately in light of the reputational impact to the group. That was the letter from the Chief Risk Officer to the Chair of the Risk Committee.
Yes, that's correct.
And the second attachment to Mr Cohen's paper was a table which commences at 1999. This is a table setting out the matters considered by the Risk and Remuneration Review Committee. It's a 5-page long table.
Yes.
And it sets out a large list of risk matters.
Yes, it does.
Each of which we see has an identified loss amount attached to it.
Yes.
And a business unit attached to it.
Yes.
And a brief comment about the nature of the risk matter.
Yes.
And a date on which the risk matter was closed.
That's correct.
But no information about how serious each particular risk matter was?
No, other than the loss amount.
No information about which executive or executives were accountable for each risk matter?
No, other than signalling the actual division.
The business unit. Nothing about how each risk matter reflected a particular executive's handling of risk issues?
No.
Do you think this information was adequate for the Remuneration Committee to make a decision about the impact of risk on remuneration outcomes for its executives?
I think the use of this information and the conclusions that the Remuneration Committee came to at that time in terms of remuneration consequences were inadequate.
Do you agree that this information was inadequate information to provide?
It was important information but not sufficient.
Mm-hmm. So I think you agree that it was inadequate.
I do.
And if we look at this page, 1999, we see that the list included, about halfway down the page, an entry for ineffective provision of ongoing service with a loss amount of $114.9 million.
That's
you
correct.
See that?
Yes.
Is that a reference to the fees for no service failings?
Yes, it is.
And we see that that issue is described as closed in July 2015.
Yes.
But we saw from the documents I took you to yesterday that this was still a red audit issue in December 2016.
That's correct.
So it hadn't been resolved by July 2015.
No, it hadn't.
And the table also includes at 2001, again about halfway down the page, a reference to the AUSTRAC Intelligent Deposit Machines Threshold Transactions Reports issue. Do you see that?
Yes, I do.
That's part of what led to the AUSTRAC proceeding the following year.
That's correct.
And that issue was described as under consideration and not closed.
Yes.
Now, I've just picked out 2 issues from the 5 pages of risk issues that Mr Cohen identified. But despite all of those issues, we see that Mr Cohen did not believe that there were any risk issues or risk behaviours that would suggest that short-term incentive awards should be modified in any way for any of the executives connected with these risk issues.
That was his conclusion, yes.
Now, I'll tender that document.
Remuneration Committee papers, 5 August 16, CBA 100400411992, Exhibit 7.39.
Now, if we turn to the minutes of the 5 August 2016 meeting, we can see how the Remuneration Committee dealt with that report. That is CBA 1004 0139 0004. Now, if we could have that page and the following page on the screen together. Have you reviewed these minutes of the meeting of the Remuneration Committee on the 5th of August, Ms Livingstone?
Yes, I believe I have.
And you've seen from the minutes that the Chair of the Risk Committee supported Mr Cohen's assessment?
Yes.
But he noted that there were issues that might affect remuneration outcomes in the future?
That's correct.
Was it CBA's approach at this time to wait until a risk had eventuated publicly before imposing any sort of consequence for failing to manage that risk?
I don't believe that was the intention, but it might be the impression created.
It was the outcome, was it not?
Well, I can't speak for what happened before I joined, and maybe there were consequences that were not linked to a media event. So I can't confirm that that was the case, but certainly.
But this was a process that you were part of because you were on the board when these recommendations were presented to the board.
I was not on the Remuneration Committee.
No, but we'll come to the ultimate stage, which was the board, and you were on the board when the ultimate decision was made.
Yes, but I had only been on the board for 2 meetings prior to this, and I was not at the June meeting.
Mm-hmm. But you were on the board when the ultimate decision was
Yes,
made. You
correct.
were part of that decision.
Yes.
Yes. Now, some of the risks in Mr Cohen's table had existed for a very long period of time, hadn't they?
Yes.
And particular managers and business units had failed to mitigate those risks over a long period of time.
That is the evidence, yes.
And wasn't that failure in itself something that warranted an adverse remuneration outcome?
I would agree with that, and as I've said, Ms Orr, the process around the remuneration outcomes for 2016 was patently inadequate.
Mm-hmm. I'll tender this document. Commissioner?
Remuneration Committee minutes of meeting 5 August 16, CBA 10040139 0004, Exhibit 7.40.
So subject to the Risk Committee accepting Mr Cohen's assessment, the Remuneration Committee didn't seek any further input from the Risk Committee, did it?
Well, I was not at the Remuneration Committee meeting, so
But
I
you've
don't know.
reviewed these documents.
Yes, I have, but I don't know what other conversations might have occurred.
Do the documents suggest that anything further was sought?
No, they don't.
No. Do you think that was appropriate?
No, I don't, because if you look at our process now, we also include, obviously, the reference from the Audit Committee.
Mm-hmm. All right, so 3 days after this meeting, on the 5th of August 2016, the Remuneration Committee considered the CEO's recommendations about the performance of the group executives and whether, based on their performance, they should receive their short-term variable remuneration.
That's correct.
And at that meeting, on the 8th of August 2016, the committee considered the recommendation from the Chair also about the performance of the CEO.
That's correct.
And whether, based on his performance, he should receive short-term variable remuneration and how much he should get.
Yes.
Now, if we turn to CBA 1004 0041 1929, we see the agenda for the meeting of the Remuneration Committee on the 8th of August 2016. And if we look at the agenda for that meeting, we can see that item 4A was the outcomes for the group executives and item 5A was the outcome for the CEO.
That's correct.
And that 10 minutes was allowed for presentation of papers on each of these topics and discussion on those points.
Yes.
And if we turn to the paper for item 4A at 1966, we see from the first paragraph that this paper provided recommendations for the committee's consideration regarding performance and short-term incentive outcomes for the group executives and Rob DeLuca to enable the committee to make a recommendation to the board. You see that?
Yes, I do.
And at 1968, if we turn to the last page of the paper, we can see that it was prepared by Mr Narev, who was then the CEO.
That's correct.
So the CEO made recommendations to the Remuneration Committee about the remuneration of the group executives, and the Remuneration Committee considered those recommendations and then made a recommendation to the board.
Yes.
And if we turn back to the second page at 1967, we can see where Mr Narev addressed the issue of risk insofar as it related to executive performance. Mr Narev said, "Risk is a key factor in considering short-term performance. Each executive has a risk and reputation KPI as a gate opener in his or her scorecard. The financial KPIs also incorporate a risk adjustment measure through the use of PACC, as PACC takes into account not just the profit achieved, but also the risk that was taken to achieve it. Executives are also required to comply with risk appetite statements. STI awards are adjusted downwards where material risk issues occur. Several risk-related matters impacted financial performance for the year. For example, remediations. I have not adjusted business unit level KPIs for those matters. Weaknesses in the operational risk framework and some aspects of issues management have been reflected in the performance assessments for some group executives. I'll provide some commentary on this at the meeting. Risk is also managed through the compulsory 50% deferral of executives' STI outcomes for a period of 12 months and delivery of 1/3 of their total target remuneration after a 4-year period. Under the group's remuneration policy, the board has discretion to make adjustments to deferred remuneration in various circumstances. Adjustments can include partial reductions or complete forfeiture of deferred STI awards. I am not aware of any reasons why deferred STI should not be paid in full to all relevant executives." That was Mr Narev's recommendation.
Yes, it was.
And if we turn to attachment A at 1969, we see how the recommendation was recorded for each of the group executives. Mr Narev recommended that all of the group executives receive a rating of fully met for their risk gate opener.
Yes.
Is that correct? He recommended that none of them have their short-term incentive adjusted for risk matters, a 0% risk adjustment for each of them.
That's correct.
And apart from Mr DeLuca, who was on a different sort of scheme, he recommended that each of them receive more than 100% of their target short-term incentive.
That's correct.
All right, I'll tender that document, Commissioner. Would you like to reflect on those recommendations before we move to how they were received?
Before we get to
I'm
that,
sorry.
Remuneration Committee Papers, 8 August 16, CBA 1004 0041 1929, Exhibit 7.41. Now, your question
I'm
was...
sorry, Commissioner. Jumped the gun. I was interested in whether at this stage, before I move to how these recommendations were received, whether you'd like to reflect on the recommendations made by the CEO.
Well, I think, as I've indicated, that there are individuals here for whom the level of award was not appropriate in light of the risk matters, which, as you pointed out, were on foot in the group at the time. Subsequently, one executive's STI award was reduced downwards, but even that reduction was patently inadequate for what was going on at the time.
Mm-hmm. How many of these executives do you think should have had a risk adjustment recommended by the CEO?
Well, I would probably say, based on what I've known, I would say most of them.
And what would you regard as an appropriate risk adjustment for the CEO to have recommended based on what you know?
Well, in some instances, probably 100% reduction, which is the approach that, as you know, we've taken subsequently.
All right. Can I ask you to look at the minutes for the Remuneration Committee meeting on the 8th of August 2016, CBA 100401213481. Now, you weren't at this meeting of the Remuneration Committee, but you've reviewed these documents.
It hasn't come up on the screen yet.
I understand that. It will come up, but have you reviewed that document in the material that you've reviewed prior to giving evidence?
I think I will have, yes.
And on the first page of this minutes of the meeting of the Remuneration Committee on the 8th of August 2016, we can see that the committee continued its consideration of Mr Cohen's letter in relation to risk outcomes, and it accepted that letter. Do you see that?
Yes, I do.
And over the page at 3482, the committee noted the matters set out in the attachment to that letter, which I took you to earlier.
Yes.
But otherwise said nothing about the risk-related issues.
That's correct.
And then at 3483, we can see where item 4A was dealt with, which was the discussion of the short-term incentive outcomes for the group executives. Do you see that, Ms Livingstone?
Yes, I do.
The CEO presented his paper discussing with the committee the rationale for his recommendations. Subject to reducing the percentage of STI target payable to the group executive wealth management to 95%, the committee resolved to endorse for board approval the CEO's assessment of the relevant executive's performance and the CEO's recommended FY16 short-term incentive outcomes for the executives.
That's correct.
So the committee resolved to recommend that the percentage of the target payable to the group executive for wealth be reduced to 95%, but otherwise accepted Mr Narev's recommendations.
That's correct.
Do you know why the Remuneration Committee decided to recommend reducing that one executive's amount by 5%?
My understanding is to reflect the Comyn issue.
A 5% reduction.
As I've indicated, that is patently inadequate, and my board colleagues would recognise that today.
Do you think the Remuneration Committee had adequate information to make a proper assessment of the risk behaviour of the group executives?
The information, as I've said already, could have been more comprehensive.
Do you think the Remuneration Committee did enough to challenge the CEO's recommendations about the short-term variable remuneration for his group executives?
The record would suggest not.
Was 10 minutes long enough for the committee to meaningfully engage with the CEO about his recommendations?
No.
And were the recommendations of the Remuneration Committee appropriate in your view?
On reflection, no, they weren't.
And the Remuneration Committee ought to have rejected the CEO's recommendations?
Well, ought to have challenged.
Should it have challenged and then rejected?
Well, challenged and then determined alternative outcomes.
Tender that document, Commissioner.
Remuneration Committee minutes 8 August 16, CBA 100401213481, Exhibit 7.42.
Could we go back to CBA 100400411929, which is the agenda for the Remuneration Committee meeting on the 8th of August? What I want to do is look at the attached papers for item 5A, which is about the CEO's remuneration. and the paper for that item is at 1972. And this paper, when it comes up on the screen, set out a recommendation to the committee from David Turner, who was then chair of the board, about Mr Narev's remuneration.
That's correct.
And we see at 1972 that the assessment of the CEO's performance is conducted at a closed meeting of the non-executive directors in October of each year.
That's correct. That
Now,
was the case at the time, yes.
You would have participated in the October 2015 assessment. You participated in more recent assessments of the CEO's performance?
That's correct. Well, I've done the assessment.
Yes. Now, at 1973, we see the scorecard outcomes for Mr Narev. You see that?
I do.
There's no particular risk item in Mr Narev's scorecard.
No.
But like the other executives, he had to meet a risk gate opener.
Yes.
And the board had a discretion to reduce his variable remuneration for risk-related reasons. Is that right?
That's correct.
And we see in paragraph 5.7 how the Comyn issues were reflected in Mr Narev's assessment. The group's reputation has suffered this year in relation to Comyn. Ian has self-assessed this portion of the scorecard, which represents 10% of the total, at 50%. But for these issues, Ian's performance would have been on target and assessed at 100%.
Yes.
See that? But the chair of the board did not otherwise recommend that Mr Narev's remuneration be reduced for risk-related reasons.
That's correct.
He recommended at 1974 that Mr Narev receive 108% of his target bonus.
That's correct.
That was a recommendation that he receive short-term variable remuneration for this financial year of $2.862 million.
That's correct.
For this year, in which there were ongoing investigations into CBA's life insurance business, known problems with anti-money laundering compliance, it was known that customers had been charged fees for no service, and it was known that consumer credit insurance had been missold. Do you agree that they were all things, that was the context for this recommendation by the chair of the board for Mr Narev to receive a short-term variable award of $2.862 million?
I do.
Do you have any reflections on that recommendation, Ms Livingstone?
As I've indicated, we have all reflected on these outcomes and would regard them as inappropriate. Perhaps I'll repeat that we've all reflected on these outcomes and would regard them as inappropriate.
Regard them as inappropriate. This was the period within which you yourself had no faith in management in their dealings with you about the AUSTRAC issues or in the audit dealings.
I was coming to that view. As I said earlier today, I firmed up on that view by the October meeting.
I see.
But I recognised at the time that I didn't have the detailed knowledge that my colleagues had.
Now,
Can we go behind the answer just a little, Ms Livingstone? Scorecards present an aura of mathematical precision to the calculation, do they not?
I agree, Commissioner.
And intended that to elicit any amusement. And going through this process, we see a high degree of specificity and a high degree of detail at various stages. Is that right?
That's correct.
Does the degree of specificity and detail that is applied in truth serve to mask the lack of critical judgment about what really matters?
I think that's, Commissioner, that's correct certainly at this point in terms of how the scorecard framework is applied. That's not the case now in terms of the discussion which accompanies the scorecard, both in terms of input from the other committees as well as the substance of the scorecard. It is one element. At this point, it was virtually the only element.
Well, the masking that was occurring at this time was a masking of what were the criteria that should have led to an outcome that you would regard as proper. Is that right?
That's correct.
That is to say, the scorecard and the various steps that were taken were masking or failing to identify or not identifying properly criteria of importance. Do you accept that?
I do, and that's why we now have a much more comprehensive assessment on using our risk scorecard before we even get to the financial scorecard.
Ultimately, someone in the organisation, ultimately I think it has to be the board, has to stand back and look at what is proposed and make a judgment about the sufficiency and correctness of the result that is proposed. Is that right?
That is correct, and that is what the board did in FY17 and again in FY18. The process of coming to the outcomes for individual executives was an iterative discussion with the CEO after having considered the risk scorecard and the KPI scorecard. So the board exercised quite a degree of inquiry on individuals, and the outcomes were varied as a result.
But in the end, is the board in a position where it can determine whether particular very senior members of the leadership team have or have not performed at, below or above what is required of them?
I think we are now much better informed in that regard, and I think we have to take into account a number of factors, including our observations on their performance during the year when they've come before the board, the observations in terms of the matters that have come before the audit committee and the way they've responded to those, and also the risk committee. So the outcome is based on an observation over a year as much as on documentation at the end of the year. But I think the board is in a position to form a view about the performance of individual senior executives.
And ultimately, the question can be reduced to, do scorecards give an appearance of precision to what ultimately has to be a matter of judgment?
If scorecards were used on their own, that would be the case. But because we combine them with other elements, that appearance of precision is mitigated.
Yes. Yes, Ms. Orr.
The Remuneration Committee accepted the Chair's recommendation about the remuneration of the CEO.
Yes, it did.
As did the Board.
Yes, it did.
And the Board accepted the Remuneration Committee's recommendations about the remuneration of the Group Executives.
Yes, subject to that one adjustment.
The adjustment that the Remuneration Committee recommended, yes, of 5%.
Yeah.
Now, I want to ask you about the same decision-making process in the 2017 financial year, but before I do that, I want to deal with one other aspect of the 2016 remuneration report. At CBA's annual general meeting, CBA's shareholders have the opportunity to vote to adopt the remuneration report.
That's correct.
And in 2016, 50.91% of the votes were against the remuneration report.
That's correct, as I referred to earlier this morning.
And that was partly the result of the remuneration decisions that I've just asked you questions about.
That was one of the contributing factors. It was more than remuneration, but in terms of the remuneration report, the outcomes, particularly in relation to the Group Executive for Wealth, were an issue. But very specifically, the proposals in relation to the changes to the long-term variable remuneration, shareholders, both retail and institutional, found unacceptable because it appeared to make it easier for executives to receive long-term variable rem, the way it was restructured.
I want to ask you about those changes, those proposed changes, which you say were a contributing factor to the vote on your remuneration report that year. If we go back to the 2016 annual report and the message from the chair of the Remuneration Committee, RCD 0021 0028 0001, at 0049, we see when it comes up on the screen, Ms Livingstone, an explanation in the message from the chair of the Remuneration Committee for the proposed changes under the heading Remuneration Changes.
Yes.
We see that here the remuneration report foreshadowed changes to executive remuneration for the 2017 financial year. And the first bullet point under this heading recorded that the scorecards for executives were to be amended to include an assessment of exemplary leadership and exceptional personal demonstration of CBA's vision and values.
Yes.
And the second dot point recorded that the GLRP, which was the Group Leadership Reward Plan, was going to change.
That's correct.
And that's the long-term variable remuneration plan.
Yes.
And the criteria for getting your long-term variable remuneration were going to change in that the criteria for assessing eligibility were going to be amended to include a new measure, a new people and community measure, weighted at 25%.
That's correct.
Now, if we turn over a few pages to 0056 and 0057, we can see from those pages, when they come up on the screen, how the long-term variable remuneration scheme was structured in the 2016 financial year prior to the proposed changes.
Yes. Yep.
And executives were granted a certain number of reward rights.
That's correct.
And at the end of that 4-year performance period, there was, as we discussed earlier, a determination about whether the rights would vest.
Yes.
And if they vested, the executives received 1 share for each right.
That's correct.
And whether the rights vested depended at this time on 2 performance hurdles. The first was a total shareholder return hurdle.
That's correct.
And that determined whether 75% of the rights would vest.
Yes.
Can you explain how the total shareholder return hurdle works, Ms Livingstone?
Yes, it takes into account both the movement in the share price and the dividends over the period. And it's relative to, as I think it describes over the page, it's relative to a peer group of the ASX 20, excluding the bank and resource companies. So it's a relative performance.
It compares CBA's total shareholder return over the 4-year performance period.
That's correct.
To the total shareholder return of the 20 largest ASX listed companies.
That's right.
And
excluding resources.
Excluding resources, and there's an assessment made of which percentile CBA is in within those 20 companies excluding resources.
That's correct.
Now, the second hurdle, in addition to the total shareholder return hurdle, was a customer satisfaction hurdle.
That's right.
And that determined whether the remaining 25% of the rights would be vested.
Yes.
And how did that hurdle work, the customer satisfaction hurdle?
It worked in relation to the outcome of surveys by external parties like Roy Morgan and whether CBA retained its number one position in relation to customer satisfaction.
So on the 30th of June 2016, the 4-year performance period ended for reward rights that had been granted in 2012.
That's correct.
And we see from this page that only 20.31% of those reward rights vested.
That's correct.
None of the reward rights vested against the total shareholder return hurdle.
Yes.
And of the remaining 25% that depended on the customer satisfaction hurdle, just under 90% vested.
That's correct.
And that gave the total that you referred to earlier of about 20% of the
Yes.
total award vesting. Then if we turn to 0058, we can see what the plan was to change this. The board wanted to change the length of the performance period
That's correct.
and reduce the share of the award that was attributable to the total shareholder return hurdle from 75% down to 50%.
That's correct.
And you wanted to add a new people and community hurdle, which would determine whether that 25% that you'd removed from the TSR hurdle would vest.
Yes, that's correct.
And that hurdle was explained on this page as measuring long-term progress in the areas of diversity and inclusion, sustainability and culture, and aiming to strengthen the group's culture by further aligning the executive reward framework with the group's vision and values.
That's correct.
Why was that hurdle sought to be introduced, Ms. Livingstone?
Again, my understanding was that the view of the board was that there should be more of a non-financial emphasis in the long-term variable remuneration, and the view that the commitment to community and sustainability and diversity were elements which underpinned the long-term value creation for the company.
And did you support these changes to the long-term variable remuneration framework?
Well, they were represented as being supported by shareholders, and in fact that shareholders would view these very favourably. So on the basis of that, yes, I was part of the decision of the board to approve the remuneration report. As we know, in the event, shareholders were not supportive
Yes,
of
and
this.
I'll come to that, but before we come to the reaction, were these measures that you thought were a good idea?
The inherent complexity of having multiple testing points is not a good design feature. I was and continue to be supportive of having non-financial measures in the long-term remuneration plan, and as you know, we continue to do so.
Did you support the idea that one of the ways to achieve cultural change was to make a component of executives' long-term variable remuneration dependent on long-term cultural change?
In principle, yes. As long as you can, through the design feature, be clear about how you expect that to be achieved.
Now, more than half of the votes were against the remuneration report, which contained these changes, and that meant that if more than 25% of the votes were against the 2017 remuneration report at the next AGM, there'd be a spill of all the board positions.
That's correct.
And you and the rest of the directors in that event would have had to stand for re-election to the board.
That's correct.
That's called the two strikes rule.
Yes, it is.
Now, following the first strike for this remuneration report at the 2016 AGM, you met with investors to discuss their position.
Once I came into the chair role, yes.
And were the investors that you met with concerned by the first topic that I dealt with, which was the lack of consequences for CBA executives for risk and reputational issues?
They were concerned about a number of matters which we laid out in our 2017 report. including the lack of transparency in the remuneration report, the lack of transparency around the exercise of board discretion, the lack of variability in outcomes for senior executive remuneration, and as we've just discussed, the proposed structure, which in the event was never implemented, of the long-term variable.
Were investors concerned by the reduction in reliance on the total shareholder return hurdle?
It varied, but in general, yes, partly because they were concerned about the way the board would exercise its discretion in relation to the other elements.
Do you think that the two strikes rule is an impediment to the boards of financial services entities adjusting their remuneration policies in a way that prioritises or encourages positive outcomes for stakeholders other than the shareholders?
Well, I think the outcome that we achieved as a result of the work that we undertook from January 2017 through to June 2017 suggests that you can actually convince shareholders that appropriate non-financial measures can be included in the long-term variable remuneration plan. The easiest thing for us to do would have been just to take them out and revert to the previous plan. But I and my colleagues felt that having those non-financial measures in there, and the ones that we subsequently designed, so the trust and reputation and employee engagement, were actually crucial to delivering long-term value to the company, but long-term value to stakeholders. So I went round investors, and several of them multiple times, to convince them that we wanted to retain those elements, those non-financial elements, in our long-term variable reward plan. And as I've said, that was consistent with the FSB supplementary guidance and the PRA guidance. It did take some effort to convince some shareholders, but I felt the principle of the point was worth pressing.
So you had to work very hard to convince shareholders of this ahead of the next vote on your next remuneration report.
Well, we actually wanted to be ready to implement the different, because we were not just dealing with the restructuring of this, we were dealing with the restructuring of the whole executive remuneration framework beyond necessarily what shareholders might have been concerned about. Because for the reasons that you've laid out, clearly the framework at that time was ineffective and not fit for purpose, and so we were redesigning the whole framework, and we wanted it to be ready for implementation from the 1st of July 2017. So we had to finalise it well in advance of putting anything to shareholders.
Do you think that the operation of the two strikes rule should be restricted or qualified in any way to better enable financial services entities to adjust their remuneration policies to benefit stakeholders other than shareholders?
Well, I think, Ms. Orr, what we're observing, in fact, is the two strikes rule and the vote against the remuneration report is actually being used for purposes beyond remuneration. So institutional shareholders may use that vote to register dissatisfaction with other elements not related to remuneration, and I think this is causing a distortion and compromising, I think, the ability of the two strikes rule to work effectively.
What are the other things that you think shareholders are sending a message about other than remuneration in their voting?
Shareholders might not be happy with the board, but the particular directors with whom they're unhappy might not be up for election that year. I experienced an instance where a shareholder voted against all resolutions, including the remuneration report, because they didn't agree with the director who was actually going up for election, a new director that year. It's not at CBA, it's another company. So that, to me, was an inappropriate use of the vote on the remuneration report. Certainly vote against the director, but don't vote against both. We saw in the vote for our remuneration report this year a number of abstentions by shareholders, not because they had concerns with the remuneration, but they had broader issues about whether the action that we were taking to give effect to change, whether those actions were being effective, and they used an abstention from the remuneration report vote as a mechanism for that. And it's important to know that usually about somewhere around 40 to 45% of shareholders vote, which means that any shareholder who votes, effectively you can double their shareholding because of the impact that that vote has in the total. So where you have people abstaining from the remuneration report, even though they agree with it, it could, if the vote were close, actually cause a strike or a second strike, which may not have been intended, but it's just the way the arithmetic works. So I think, to come to your point on the 2 strikes rule, I certainly think having the advisory vote on the remuneration report is good. And yes, if there are 2 strikes, that's helpful. At least you have an opportunity to come back again. But I think, as I say, the fact that it's being used for purposes other than a view on remuneration is compromising its effectiveness.
So after the 2016 strike, you had to make a number of changes to your remuneration arrangements, and I want to ask you about some of those changes. They're summarised on the first 2 pages of the 2017 remuneration report that I'll take you to now. That's RCD 0021 0002 2483. And if we bring up 2548 and 2549, we see a section of the remuneration report that you'll see is headed Board Response to Concerns Raised in relation to the FY16 remuneration report.
That's correct.
And the first item in the response is the short-term remuneration outcomes for the 2017 financial year, which I want to come back to. But underneath that, the report referred to a number of changes that were going to take effect from the 2018 financial year.
Yes, so from 1 July 17.
Yes. And the first was an increased weighting on financial and quantitative measures in the short-term remuneration scorecard for executives.
That's correct.
Why did the board decide to introduce that change?
Well, we introduced that change because shareholders were, I think, rightly critical of the application of board discretion, and they wanted to see more quantitative measures, so not just financial, but more quantitative measures across the elements of the scorecards. As you know, as part of the evolution of our framework, for the following year, we have reduced the weighting of financial measures in all scorecards.
Well, over the course of this year, the Commission's heard evidence about how an excessive weight on financial measures in employee scorecards can increase the risk of misconduct or conduct that falls below community standards. In making this change to increase the weighting on financial and quantitative measures, did CBA consider that increasing the weighting for its executives for financial measures could have that effect?
No, we didn't. We didn't explicitly consider whether this would provide an incentive for misconduct, but in coming to this, as I say, subsequently, we have taken the weighting of the financial measures back down to 30%. So
My question was not about whether it provided an incentive for misconduct. It's about whether you considered the risk that this change would give rise to misconduct.
we didn't explicitly.
The next change was improved rigour of non-financial measures.
That's
Do you
correct.
see that?
Yes.
And this is about increased quantitative measurement of non-financial measures and the introduction of the Net Promoter Score customer targets.
That's correct.
The Net Promoter Score is a quantitative measure that's introduced to measure a non-financial matter, customer satisfaction. Is that right?
It doesn't measure customer satisfaction. It measures the proportion of customer advocates versus detractors. So the intent of the Net Promoter Score is to pick up those customers who are not advocates for your products.
Mm-hmm. So is that a measure of customer satisfaction essentially?
It's not the same as a customer satisfaction measure per se, because it's intended to mix the positive with the negative. So that's why it's called a Net Promoter Score.
And it's a quantitative measure.
Yes, it is, based on surveys.
Do you think that quantitative measures are a better way to measure non-financial matters than qualitative measurements?
Well, in fact, as you know, we've taken that particular measure in the scorecards for the current year, includes NPS, but also includes customer outcomes such as customer complaints. So that is the non-quantitative side that you're referring to.
But you've retained the quantitative side and added some qualitative elements.
That's correct.
And another change that we see here was the removal of the proposed people and community measure that I asked you about before.
Yes.
And why was that removed?
It was replaced with a trust and reputation measure and an employee engagement measure, which we thought were better and more specific indicators of those elements which lead to long-term value creation.
I see. So at the bottom of the page, if perhaps we could blow up the section under comprehensive review of LTVR measures, we see that the document records that after conducting a review of long-term variable remuneration performance measures, the board decided to keep the total shareholder return hurdle.
That's correct.
And to continue to have 75% of the long-term remuneration dependent on satisfying that hurdle.
Yes, that's correct.
And the customer satisfaction hurdle was replaced with the two new performance measures that you've mentioned, the
Yes.
trust and reputation hurdle for 12.5% and the employee engagement hurdle for 12.5%.
Yes.
Now, I want to ask you a bit more about the use of the total shareholder return hurdle at CBA. We've seen that for the reward rights granted in the 2016 and 17 years, 75% of the long-term incentive depends on CBA meeting the total shareholder return hurdle.
That's correct.
And that had been true for many years before the 2016 financial year.
Yes.
And it remained true for reward rights granted this year, in the 2018 financial year.
That's correct.
And you've explained how that hurdle needs to be met. Is it subject to any risk-related adjustment by the board?
Not that measure, but the overall achievement of the LTVR, either before or at the point of vesting, is subject to a risk assessment.
I see. So that's the point at which the risk-related assessment by the board enters the picture.
That's correct.
And for 2017 and 2018 financial years, there was also a positive TSR gateway. What does that mean?
That means that to receive the trust and reputation and employee engagement score outcomes, the overall outcomes for shareholders could not be negative.
I see. So CBA's long-term variable remuneration framework places significant emphasis on this one measure, this total shareholder return measure. Do you agree with that?
It does.
And in April this year, APRA released a paper that you referred to earlier in your evidence called Remuneration Practices at Large Financial Institutions.
That's correct.
Are you aware of what that paper says about use of the total shareholder return hurdle?
Yes, and there are a lot of competing views on the appropriate, if you like, financial element to put into a long-term variable remuneration framework.
But are you aware of the views expressed by APRA
Yes.
on the use of the total shareholder return hurdle?
I understand that it's not favoured as a measure.
It's not favoured, did you say?
Yes.
APRA has expressed concern about an excessive focus on return measures such as total shareholder return, hasn't it?
Yes, it has.
And those concerns have been expressed also by the PRA, the Prudential Regulation Authority in the UK.
Yes.
The PRA, excuse me, said that performance measures like total shareholder return are not suitably adjusted for long-term risk factors and may incentivise highly leveraged activities. Are you familiar with that statement?
I am, but again, I'd say that the outcomes and the vesting, and that's the point at which the board exercises discretion, and if there have been adverse outcomes, then the LTVR doesn't vest.
So the APRA information paper was released in April this year, before you released your most recent remuneration report.
That's correct.
And as a result of that APRA paper, did you reduce your reliance on total shareholder return?
No, we haven't, but as I've said, we are undergoing another whole review of the remuneration framework and the working of the short-term and the long-term variable remuneration.
Do you think it's appropriate to have such a large proportion of the long-term incentive for your group executives depend on a purely financial matter?
I think as reflected in our structure at the moment, we do think that is, it's a measure we can use. It's not EPS and it's not ROE, which are directly, if you like, influenceable by management. The total shareholder return relies on market influence, not just what the company does. So it does have a degree of reflection of external perception and external views. It is not, it is far from a perfect measure, and that's again why we're going through another review to see if there's a better framework. And in fact, we're consulting with the PRA next month on this.
Consulting with the PRA on what?
On their views on remuneration frameworks.
And why are you consulting with the PRA, the UK Prudential Authority?
Well, as part of getting an international perspective. We can observe what's happening in our market, but we will also get an international perspective. And we have to meet with the PRA in any event because we have employees in the UK.
But you know what the local Prudential Authority's perspective on this is from the document produced by APRA in April this year?
We do, and we're having regard to that perspective. But as I say, we're trying to look at effectively what a comprehensive redesign could be that doesn't have, as I said earlier, the unintended consequences.
Which unintended consequences are you referring to there, Ms.
I'm referring
Livingstone?
back to whether you have the design of a system which unduly weights the short term, if you like, masquerading as a long-term plan.
I see. All right, now if we can just go back to the document on the screen, the final change that was mentioned there as part of the response of the board to the concerns raised for the FY16 remuneration report is at 2549. We could go to 2549 and blow up the section headed Enhanced Risk and Remuneration Governance. I want to ask you about this set of changes and then turn to the decisions of the Remuneration Committee and the Board about short-term variable incentives in the 2017 financial year pursuant to this new risk and remuneration governance. So the changes to the risk and remuneration governance were proposed in about April 2017.
That's correct.
And by that time you were chair of the Board?
That's correct.
And you were a member of the Remuneration Committee?
Yes.
Could I take you to CBA? Well, I'm sorry, I think I need to tender this document before I move away from it, the 2017 annual report.
CBA Annual Report 2017, CBA 0021 002 2483, Exhibit 7.43.
Could we now look at CBA 1004 0041 2374? Which is a paper prepared for the Remuneration Committee by David Abusa, Executive General Manager, Performance and Reward, from the 10th of April last year. Now, this paper proposed a number of changes to executive remuneration processes in light of the strike on the 2016 Remuneration Report.
Yes, in light of the strike and also looking at enhancements that we could do, notwithstanding the strike.
Now, if we turn to, I'm sorry, the first page of the paper is at 2419. I'll just bring that up to show you. You're familiar with this paper, Ms. Livingstone?
If I could just have a moment to review it. Yes.
And if we turn to 2422, which is attachment A to the paper, we see a summary of the risk adjustments that CBA had made to executive remuneration in the past. We see here that from the 2011 financial year to the time of this paper, there were only 7 instances involving 5 executives where an executive's short-term remuneration was reduced as a result of a risk issue.
Yes.
And with one exception, they involved reductions of 20% or less.
That's correct.
And in each case, the reason for the reduction, as explained in this document, was damage to CBA's reputation.
Yes, well, there's the misconduct one as well.
Was that a reputational problem?
Again, that's before I joined the board, so I can't comment on whether the primacy was misconduct or reputation.
And the others, you agree, all relate to reputational damage?
I think from again, I was not on the board at the time, but the document refers to the particular issue. So, for example, in advice and also the public scrutiny.
Yes, well, we see in every entry, other than the misconduct activities entry that you referred to, either the use of reputational risk, reputational damage, or intense public scrutiny.
Was one of the factors that would have obviously gone into the consideration, but I was not there at the time.
From the 2011 financial year, CBA had never reduced an executive's short-term remuneration as a result of a risk-related issue that had not yet been made public.
Based on this evidence, no.
Do you think that sends the right message to CBA's employees?
If you draw that conclusion, no, it doesn't.
What message do you think it sends?
Well, clearly that there'll only be consequence if there is a public event, a media event.
If it's found out, if the public learns of the problem?
That would be the inference, yes.
You accept that's the inference from what you see on this page?
I do.
One of the changes that was proposed at this time was to introduce a new executive risk scorecard. You referred to that earlier in your evidence. Can you explain that scorecard?
So it has, it assesses the individual on a number of elements. One is the risk culture and leadership.
And I'll just ask you to pause for a minute because it might assist you if I bring it onto the screen at the time. 2424. And it might assist us to understand your explanation.
So, as you can see, it has the four quadrants, so the one I just referred to, the risk culture and leadership, then risk strategy, risk appetite, risk and control environment, and incidents and issues.
And before this scorecard was introduced, did CBA have any formal framework for the assessment of an executive's risk performance?
Not in this way, and not...
in any way?
Well, there was, if you call the Chief Risk Officer's assessment a framework, that was the only framework, but this is a very specific individual assessment, which, as you can see, also includes a self-assessment, which gives a guide as to the culture mindset of the individual.
All right. I'll tender that document, Commissioner.
The Remuneration Committee Papers, 10 April 17, CBA 100400412374, Exhibit 7.44.
The Remuneration Committee recommended the changes in this paper to the Board.
That's correct.
And the Board adopted those changes.
Yes.
And they were applied in determining executive remuneration in the 2017 financial year.
They were.
And the Remuneration Committee met in June 2017 and discussed the risk-related adjustments that should be made for the 2017 financial year.
Yes.
And by that time, CBA's fees for no service conduct had been made public.
Yes.
And CBA had entered into an enforceable undertaking in relation to its foreign exchange trading.
Yes.
And ASIC's investigations into CBA's life insurance business had mostly concluded, apart from an ongoing investigation by ASIC into whether CBA's advertising was misleading to consumers. So those things occurred, and at a meeting in July 2017, the Remuneration Committee considered the CEO's recommendations for the remuneration of his executives.
Yes.
Could I ask you to look at CBA 100400412546? This is the agenda for the meeting of the Remuneration Committee on that date.
Yes.
And item 7 was the discussion of group executive remuneration, and that was scheduled for a 15-minute discussion.
Yes.
And if we turn to the paper for item 7 at 2652, we see that the CEO said in the first paragraph, at its June meeting, the committee received my initial high-level recommendations on FY17 performance and remuneration outcomes for current and former group executives. The initial recommendations did not yet include adjustments for risk and reputation issues, and this is an area in which the committee provided specific guidance. You see that?
That's correct.
And over the page, we see at 2653 to 2654 a discussion of the recommended adjustments. So for the 2017 financial year, we see in paragraph 3.5 that the CEO recommended a 10% reduction for all group executives for long outstanding items. Do you see that?
Yes, that's correct.
A further 10% reduction for certain group executives, including Mr Comyn, for control weaknesses relating to anti-money laundering and counter-terrorism financing regulation.
That's correct.
A further 20% reduction for the Group Executive for Wealth Management as a result of the fees for no service issue.
That's correct.
And a further 25% reduction for the Group Executive responsible for enterprise services as a result of weaknesses in controls and effectiveness.
Yes.
And if we turn over the page to 2655, we see that in contrast to the previous year, all of the group executives received a rating of partially met rather than fully met for risk.
That's correct.
And they each received a downwards risk adjustment to their short-term variable remuneration of between 10 and 35%.
That's correct.
Now, I'll tender that document, Commissioner.
Remuneration Committee Papers, 11 July 17, CBA 100400412546, Exhibit 7.45.
At the July meeting, the Remuneration Committee broadly approved these remuneration outcomes.
Yes, we did.
And you were present at that meeting?
Yes, I was.
Now, I want to come to what happened in August in a moment, but reflecting on what happened at that meeting of the Remuneration Committee in July last year, do you think that those remuneration outcomes for the group executives were appropriate?
I think in hindsight, we could have done a greater risk adjustment on several executives, including to zero.
And who would you have reduced to zero? Who should you have reduced to zero?
This is awkward in terms of individuals.
So some but not all?
Some but not all. No, certainly not all.
The CEO? We'll come to the CEO separately. Perhaps I'll do that in order. I'm just trying to understand if there's a way that you can identify categories of individuals within here who you think ought to have been reduced down to zero.
Probably the ones with the higher risk adjustments.
I see. So with the risk adjustments of 20% or more?
Well, certainly the 30% or more.
30% or more?
Yep.
Only those ones?
In terms of going through to zero?
Yes.
Yes.
And do you think that you should have reduced further others?
So I'd go back to the 10% factor that was in there for the AML, and the board had said to the CEO that while we were understanding, and this is before the proceedings obviously had been lodged,
yes,
but while we were understanding more about the significance of those issues, and this comes to the action that we were taking to understand the detail in our control environment around AML CTF, getting to root cause, that there should be a factor in there for that, almost as a marker, but recognising that when we did get to root cause and have a fuller appreciation of the level of our financial crimes compliance, there would be a further adjustment.
So do you think, reflecting on it, that the 10% across the board reduction for the anti-money laundering issues was inadequate?
In the light of subsequent events, it was clearly inadequate, which is why we then made the further adjustment.
In light of the proceeding being brought against CBA, they're the further events that you're referring to?
And in terms of what we then became aware of, which we would have become aware of as we sought root cause on what the issues were, but we were partly through the process. When AUSTRAC lodged its proceedings, we became aware of matters that we had not known at the time. So had we known those issues, the adjustment would have been greater, and in the event, it was 100%.
But you did know that there'd been consecutive red-rated audit reports in this area for multiple years.
We did, but we also knew that a great deal of work had happened, and you take the 400 million that had been invested in the systems. But again, the ability to articulate the problem and get to the root cause was still not well developed. So yes, there are red audits, but there was the offset of all the work that was going on.
All right.
So it wasn't a situation that nothing was being done about the AML-CTF Act compliance. A great deal was going on.
Mm-hmm. But the problems had not been fixed, and they were long-standing problems, weren't they?
But that's what I'm saying. The articulation of the problem was not clear. So certain aspects were fixed, and then other aspects would appear, which meant that there wasn't a complete understanding of what the problem was. The root cause analysis was only just being done, and we were having various groups, consultants, help us with the understanding of root cause.
And that hampered the board's ability to give appropriate remuneration consequences, didn't it?
The fact that we didn't know what the scale of the issue was, yes, it did, but we were signalling that there will be consequences, so it wasn't a situation that there couldn't be consequences until we found out more. There was an element in the risk adjustment which said there will be consequences, but we need to understand the situation a lot better first.
The proposed risk adjustment for the CEO, Mr Narev, for this year was about the same as what we see here, wasn't it? It was a reduction of 20%.
Yes, it was.
And do you think that was appropriate?
So, in an absolute sense, and again with hindsight, it should have been more.
What should it have been?
Well, in hindsight, it should have been zero, which is where it ended up.
Right.
But I would say that one of the aspects in all of executive remuneration, which is, it's an explanation, it's not in any way an excuse, but the fact that all of these remuneration elements are disclosed under the KMP disclosure requirements means that they carry not just a financial impact, but a reputational impact. And at this level, executives are very cognizant of the reputational impact as much as of the financial. So if you want to deliver a message to an executive, that reputational impact dimension is also important.
That's why it's very important to use the powers that you have to send consequences via remuneration reductions, isn't it?
Absolutely. And so if you're asking me about the CEO, at that time, to get anything less than 100% was unheard of, and to get down to 83% was effectively an adjustment that was considered very significant on his part. So in that sense, that was a very major message being delivered to him, that the variable pay is truly variable and it will be below 100%.
But do you accept that the matters that I took you to at the start of these questions about the events in this financial year warranted a very significant consequence for the CEO and a very strong message?
Well, what I'm saying, Ms. Orr, is that a very strong message was delivered, but I also accept that the financial consequences and the adjustment should have been greater.
Yes, well, a 20% reduction in your variable remuneration is not a very strong message in a year with fees for no service, enforceable undertakings about your foreign exchange trading, your life insurance business being under investigation, things of that nature, the AML problems.
I accept that.
All right, thank you. Now, a few weeks after this meeting, on the 11th of July, on the 3rd of August, AUSTRAC commenced the civil penalty proceeding against CBA.
That's correct.
And a few days after AUSTRAC commenced that civil penalty proceeding, on the 7th of August, the Remuneration Committee had its next meeting.
That's correct.
Could I take you to CBA 1004-0128? You were present at that meeting of the Remuneration Committee, Ms Livingstone.
Yes, I was.
Do you remember this meeting?
Vividly.
Now, the first page of the minutes at 3528 records that the non-executive directors met in private and discussed the risk and reputational matters affecting the group and the related considerations for the executive remuneration outcomes in FY17, including for the Chief Executive Officer. They then record that Mr Narev joined the meeting after that discussion. Now, I want to ask you about your recollection of that private discussion of the non-executive directors in Mr Narev's absence a few days after AUSTRAC commenced its civil penalty proceedings against CBA.
So the discussion, and as you can see, all directors were there, was to determine, in the light of what had happened, what the remuneration consequences should be and how they should be delivered through the remuneration framework, whether they should be delivered through short-term variable rem or long-term variable rem, and what quantum. And also, I propose that all directors take a 20% penalty on their fees. So I put that to the meeting as well.
That was your idea? That,
yes, it was.
The non-executive directors take a 20% cut on their fees?
Yes.
What about the CEO? What was the discussion about the remuneration consequences for him?
So where we had quite a debate as to the best mechanism to use to deliver the consequences, and in the end the board determined that reducing the current year short-term variable rem to 0 was the appropriate consequence, given that at that time we were not fully aware of all the matters that were covered in the proceedings. So the view was that we should leave the long-term variable rem on foot in terms of the deferred rem, so that if there was a need for consequences further down the line, we would still have that option to exercise discretion then.
Did anyone argue for immediate consequences in relation to long-term remuneration?
There was a mix of views. Some people, in fact, I felt my own view at the time was we should consider a mix of short-term and long-term. We had a good discussion, which is why you have a board and you have the diversity of views. And the outcome of that discussion was that the immediate consequence would be delivered through a 0 short-term variable rem, rather than adjusting deferred long-term variable rem on foot.
And did anyone argue against a 100% reduction to the short-term variable remuneration?
No, it was a unanimous decision.
And you were persuaded in that discussion that there should be no long-term variable remuneration consequences at this time?
At that time, yes, for the purposes of enabling subsequent board discretion.
And what about the other group executives? What did you discuss about consequences for them?
That the discussion covered all, the CEO and all group executives.
Mm-hmm. And did anyone suggest to the contrary in terms of reducing their short-term variable remuneration to 0?
Well, that was the discussion, that we would reduce everyone to 0.
There was no separation between the CEO and the group executives?
No, 0 was 0.
I see. The minutes record that Mr Narev then joined the meeting and the directors continued to discuss the outcomes on group executives' remuneration that it would recommend to the board. What do you recall of that discussion after Mr Narev joined the meeting?
Well, the discussion was basically informing Mr Narev of what the outcome of the board's decision was. Well, the Remuneration Committee, but clearly it was going to be the board's decision as well.
And after that, the Remuneration Risk Review report was tabled. Do you see that towards the bottom of the page?
Yes.
And the minutes record, if we could have both this page and the following page on the screen, that the committee noted that all directors had participated in a fulsome discussion on the risk and reputation matters affecting executive remuneration outcomes for FY17 earlier in the meeting. It was further noted that the committee had considered the key risk matters identified in attachment 1 to the paper, which I took you to earlier, as well as the impact on group's reputation of the AUSTRAC legal proceedings and accountability for those matters.
That's correct.
Now, I want to look at what the committee decided. If we go to 3530 and bring up 3530 and 3531, we see that the committee decided to recommend to the board, as you've described, a reduction in the short-term bonus for all group executives, including certain former group executives, to 0, to forfeit all of the deferred amount of the former Chief Risk Officer's short-term variable remuneration for the 2016 financial year, to reduce the amount of that same former Chief Risk Officer's long-term remuneration, and to reduce the short-term remuneration for the CEO to 0.
That's correct.
What did you decide about how the decisions of the Remuneration Committee that are recorded in this document would be communicated within the organisation?
So in the first instance, Ian was asked to inform the group executives that that was the board's decision, and I subsequently met with the ExCo to explain the board's decision. I wasn't in a position to meet with ExCo immediately because, as you may know, I was summoned to Canberra by the Treasurer.
How did the group executives react when they were told that they'd lost the entirety of their short-term variable remuneration?
It varied. Some were immediately accepting, some were angry, and others felt that because it had affected the whole group, including people who hadn't been there for very long, that that it wasn't fair. But the point of the board taking this view was to emphasise the importance of collective accountability, and that ExCo was a collective leadership group and not to distinguish between individuals.
And how did the CEO react to the decision about his short-term variable remuneration?
He recognised that it was appropriate.
All right. I don't think I've tendered this document, Commissioner.
Remuneration Committee Papers, 7 August 17, CBA 100401213528, Exhibit 7.46.
Now, Ms Livingstone, after this decision, APRA announced that it would conduct the prudential review into CBA.
That's correct.
And in May this year, APRA released the report of that prudential review.
Yes.
And that inquiry was highly critical of CBA's remuneration practices. Do you accept that?
Yes.
It criticised CBA's reactive approach to applying risk adjustments to variable remuneration.
That's correct.
It criticised the Remuneration Committee's reliance on the performance assessments of the CEO and the advice provided by the Chief Risk Officer.
Yes.
And it said that the Remuneration Committee did little to challenge those assessments by seeking further information.
That was their conclusion, yes.
And do you agree with that conclusion?
I think the in terms of the FY17 outcomes which were pre the AUSTRAC, we did challenge significantly the actual outcomes, and as you would have seen, the difference between the June and July outcomes as recommended by the CEO, there was a significant reduction, which came from the challenge from the board.
The Prudential Inquiry made a number of recommendations in relation to the remuneration framework at CBA.
That's correct.
And I want to ask you about a few of those. The third part of what is recommendation 25 in the report was that in support of the effective application of the remuneration framework, CBA, with due regard for confidentiality concerns, communicate the impact of both good and poor risk outcomes on remuneration across the group to reinforce the link between accountability and consequence. You recall that recommendation, Ms. Livingstone?
I do.
And did CBA do that with the most recent set of remuneration outcomes for the 2018 financial year?
Yes, it has, and the board received the proposal as to how that would be communicated over a period. So there was a communication strategy, if you like, in relation to that.
So how did you communicate that?
Through employee meetings, and also with HR actually describing how the process had worked, in employee communications or written communications. So there were a number of ways in which that was communicated. What we will do is then effectively do a review of that to see how effective that communication has been. And one of the other recommendations is more generally for the Remuneration Committee to understand how effective the remuneration framework actually is, because at the moment we rely really on, if you like, anecdotal data points. So customer complaints, the risk behaviours and analysis that the internal audit does, misconduct reporting. So, as I say, they're somewhat anecdotal, and we need a more analytical approach, which is what's being worked on at the moment. And we hope to look at that in the first quarter of next year. And that point on effectiveness was raised by the PRA as well, and by the FSB. So having a more analytical approach to understanding the effectiveness of individual frameworks, not just the senior executive framework, is part of the work of the Remuneration Committee going forward.
Did you communicate the most recent set of remuneration outcomes across the group?
The communication plan that was brought to the committee certainly envisaged that would be the case.
And did it happen?
Well, it happened, but what I'm saying is the committee hasn't actually assessed as to whether it's been effective at this point.
Why are you unsure whether it's effective?
Well, you always check when there's been a communication as to whether the communication's been effectively received. And if you, in our framework, the STVR outcomes for the broader group are only delivered in mid to late September. And it's part of the delivery there, so people will understand why they got the particular outcomes they did.
Do you think it's important for everyone within CBA, not just the people affected by these remuneration outcomes, to understand what remuneration outcomes the board has imposed on the executives?
Well, they see that publicly. They see it in the REM report.
Do they see it in any further communication internally, or do they have to rely on the annual report?
Well, it's a very public document.
Of course, but should CBA explain this to its employees before publishing the annual report?
Well, the report comes out coincident really with the decision and the results.
So that is the mechanism through which you say your employees learn of the remuneration consequences that the board has imposed on the executives.
On the senior executives.
I see. Now, you said earlier that for executives, the reputational consequences of remuneration adjustments are very important.
They're personally important, yes.
And earning more than your target short-term variable remuneration is a quantifiable indication of good performance. Is that right?
It's actually relative to your peers as distinct from the absolute.
And having your short-term variable remuneration reduced for risk-related reasons is a quantifiable indication that you've done something wrong.
As I said earlier, it may be that you haven't done something right as well.
What's the difference, Ms Livingstone?
Well, the difference is that you didn't take action that would have enhanced the risk environment, but it may not be something that you have done wrong to detriment of. So it may not be if you take the misconduct construct, it may not be misconduct, but you haven't met the expectations of the level that you might, that the board might have had or the senior executives might have had.
Is that really a distinction of substance, Ms Livingstone?
I think it is.
Do you accept that having your short-term variable remuneration reduced for risk-related reasons might affect your prospects of advancement within CBA?
It might, but given that the process is applied across the organisation and much more rigorously now, it's expected that there will be an outcome more often than not in terms of the rigour with which it's applied. So it's not an unusual event anymore that you will have an adjustment for risk outcomes.
It's not an unusual event that group executives within CBA have an adjustment for risk-related outcomes.
That's correct. If you look at the risk scorecard that we looked at, if you have incidents in your area, if you go outside of risk appetite, if you haven't demonstrated the appropriate risk culture and leadership, or if the controls in your environment as assessed by an audit report have an adverse audit outcome.
Does that concern you as the board, as the chair of the board of CBA, that it's not an unusual outcome for adjustments to be made to your executives because of failings in relation to risk culture or risk leadership or because of other risk incidents?
No, it doesn't surprise me, because in an organisation such as CBA, you would expect the inspection of all of these matters to be at the detailed level where it is picking up as many of the matters as possible. It is not my expectation that the CBA environment will be perfect.
Do you agree that it's a powerful way to reinforce the consequences of good and poor risk behaviour to make the consequences of that behaviour public?
Yes, and for the group executives, they are very public.
Because of the remuneration report, is that what you say?
Yes.
Well, can we look at the 2018 remuneration report at RCD 0021 0028 0196? And if we turn to 0295 and 0296, we see on those pages that CBA set out the remuneration consequences that flowed from the prudential inquiry. Do you see that towards the bottom of the left-hand side?
Yes, I do.
And the document records there, perhaps if we could blow that up, that the CEO and all group executives had their short-term variable remuneration for the 2018 financial year reduced by 20%.
That's correct.
And that Mr Comyn offered to forego all of his short-term variable remuneration.
Yes.
And the document records that the board decided that Mr Narev would not receive any of his short-term variable remuneration for the 2018 financial year or any of his unvested long-term variable remuneration.
That's correct.
And then over at 0296, at the top of the page, the document records that the board also forfeited the unvested long-term variable remuneration for David Craig, the former CFO,
That's correct.
and the former Chief Risk Officer.
That's correct.
And it forfeited a portion of all unvested deferred short-term variable remuneration for former executive general managers and general managers.
That's correct.
And the document also referred there to the 20% fee reduction for the board that you explained earlier.
That's correct.
But there were further remuneration consequences, weren't there, Ms Livingstone?
For, are you talking about for the APRA report specifically? The APRA.
Well, I want to ask you about the board's request that the former chair return 40% of the fees that he earned in his final year at CBA.
That's correct.
Why did the board request the former chair to return those fees?
Because the board felt that it was appropriate as chair that he also effectively participate in the reduction that we had all taken for effectively what was described in the APRA report.
So why didn't you make that clear in the remuneration report?
Because the chair, the former chair, did not agree to return any of his fees.
So although the board requested that the former chair return those fees, that request was not acceded to.
That's correct.
Do you think it was important for you to publish that the board had made that request of the former CEO? I'm sorry, of the former chair, I apologise.
Well, I suppose I didn't consider at the time including it, and maybe I should have.
Well, could I ask you to consider now whether that's a message that you think should be sent publicly, that you made a decision as a board to request the former chair to return 40% of his fees?
In retrospect, yes, perhaps we should have made that public.
Have you spoken with Mr Turner about the findings of the prudential inquiry?
I have not directly. He has communicated with one of my board colleagues.
Were there additional... he's communicated with one of your colleagues, did you say?
Yes.
And what has he communicated through one of your colleagues?
He communicated that, and I'm paraphrasing because I obviously didn't have the direct conversation, that he didn't recognise in the APRA report the CBA board that he knew.
I'm sorry, could you say that again? I didn't hear that.
He didn't recognise in the APRA report the CBA board that he knew.
I see.
But I am paraphrasing.
Yes. Were there further risk-related remuneration consequences in the 2018 financial year beyond those imposed for the prudential inquiry?
There were on individual group executives, yes.
Are they disclosed in the remuneration report?
Well, you can see them through the STVR outcomes for individual executives.
Well, what can you see through the STVR outcomes?
You can see those who got 0.
And what about those who had a reduction which was something other than 100%? Are you able to understand that from the information that's published in the remuneration report?
Yes, you can see the percent that they actually received.
Can you see the reasons for those reductions in the remuneration report?
No,
Ms.
you don't. You
Livingstone?
don't see the individual reasons in the remuneration report.
Should you be able to see those reasons?
There is probably an argument for making it clear to readers of the annual report why the adjustments were made, yes.
Well, can you see that the adjustments that have been made were made for risk-related reasons, or are you left not knowing whether it was a risk-related reduction or some other failure to meet a financial target style of reduction?
You can see from the scorecard for the CEO what the outcomes would likely to have been. There are small variations across scorecards, but you can see from the shape of the CEO's scorecard outcome what the outcomes in terms of financial outcomes would be for the group executive, so that you can see in the CEO outcomes that the financial outcome for the scorecard was 0.
But what do you see for the group executives? Do you see that they received risk-related reductions to their variable remuneration?
You can't see specifically what they were for, but the executive scorecards match the shape of the CEO scorecards. So you can look at the CEO scorecard and understand how much reduction there would be for financial measures.
So you have to extrapolate from the CEO's scorecard across to the dollar sums that are reported.
No, the percentages are there as well.
Well, could we just look at what is in the remuneration report? 0297.
Sorry, could I just go back to the previous page?
Yes, the previous page was 0295 and 0296.
So yes, so sorry, that's so you'll see under the STVR outcomes paragraph
Yes.
that it does actually describe, I accept in general terms, the adjustment to the scorecards for the APRA inquiry
Yes.
findings in the current year.
Yes, for the APRA Prudential Inquiry report's findings.
And it does then talk about further negative adjustments were made to reflect the individual accountability for other risk and reputation matters. So
And it doesn't tell you what those individual outcomes were, and it doesn't tell you anything about remuneration outcomes, risk-related remuneration outcomes beyond those responsive to the Prudential Inquiry.
not in percentage terms, but if you go to the schedule that shows the individual.
Yes, 0297.
No, the schedule that shows the percentages of STVR outcome.
0304, perhaps if we could have both of those on the screen, 0297 and 0304.
So
is it the right hand?
It's the right hand
side that you're referring to?
Could I swap them over? Otherwise,
Perhaps we can just blow up the table on the right hand side if that would assist you.
So you can see the percentages of STVR versus target.
Yes, we can see that, Ms. Livingstone. What I want to understand is why you don't tell the public how much of that reduction is related to risk adjustments, poor behaviour.
So I accept that that is not obvious, and that is something that perhaps we should consider for next year's report.
You say it's not obvious. It's not able to be worked out from the information that you provide in the annual report, is it?
Not easily. You have to cross-reference to CEO scorecard outcomes.
I'm sorry, but I don't understand how you say that could be done.
So under the CEO scorecard, you would know the proportion that had not effectively been achieved because the financials hadn't been achieved.
Yes.
So as a percent of target, you could see, for example, all right, 50% has not been achieved.
By who?
By the CEO.
And how does that help you understand the risk-related adjustments for the individual group executives?
Because the individual executives would also have a similar adjustment for not having achieved financial outcomes.
Well, how do we know that, Ms. Livingstone? How does the reader of your annual report know that?
I accept that they probably wouldn't know that.
So going forward, should you disclose in your annual reports the risk-related adjustments that are made to the remuneration outcomes for your group executives?
Yes, we should. I agree. We should disclose them in more detail. We have, as pointed out, we've disclosed what we've done for the APRA adjustment, but I agree that would probably be merit in more detail on individual basis as to what the risk-adjusted outcomes were.
Because that sends a powerful message that you as chair of the board are able to send about the way your organisation responds to misconduct. Do you agree with that?
I do agree with that.
All right. Now, I want to ask you about another recommendation of the Prudential Inquiry.
Just while you're turning to that, can I go back a stage and just see if I can put this into a framework, Ms Livingstone? There are, I think, 3 steps in these remuneration issues. 1, what are you assessing? 2, over what time? 3, how do you apply consequences? Do you agree that that's the
Yes.
broadest elements of the framework?
Yes, Commissioner.
What are you assessing? That subdivides, or may be subdivided into 2 issues, may it not? What the employee has done or not done, and second, how the employee has done it during the course of whatever the relevant period is.
Yes.
Metrics take you so far. They're particularly apt to determine what an employee has done if you are measuring financial consequences. Do you accept that?
Yes, Commissioner.
Beyond that, beyond financial consequences, whether that's sales, ROE, whatever financial metric you employ, there is a difficulty about measurement, isn't there, in assessing what an employee has done?
That's right. I mean, we do try and identify the factors on an employee-by-employee basis, but there is a subjective element.
And it becomes even harder to apply numbers when you're assessing how the employee has done it.
That's correct.
Now, the simple example is it doesn't capture readily the employee who, for perfectly good reason, says to a customer, look, I could sell you this, but you really don't need this. Therefore, don't make any change to your financial arrangements. That employee may have acted perfectly properly, perfectly soundly, and it's a bit hard to measure that, isn't it?
That's true.
It's a trivial example, but important to the customer. Over what term? All right, we seem determined on annual reviews. Application of consequences. Again, you divide it in 2, don't you? Application of consequences as individual message to the employee. But there is also, is there not, demonstration to the whole organisation of what the organisation values and what it deprecates. Is that right?
Correct.
Now, the last passage of questioning about what we can see in the annual report, etc., can I just turn it slightly? How does what appears in the annual report help to convey to the whole of the organisation what it is that the board is saying to the senior leadership team about what is valued, what is not valued, what is deprecated, what will be condemned?
Well, I accept that it's at a very high level because it turns out, or it turns on, individuals looking at the percentage of STVR achieved, but not why.
And isn't that message of why an important message to send down through the organisation? The senior leadership team has been docked X%, Y dollars, whatever it is, because what this organisation values is this, and what it will condemn is that. Now, you say communication to staff is something to look at. It's a one-page document, isn't it? Fairly simply, not simply written. It's a document that's written simply, which is a radically different task. It's a document that should be available to the most junior teller, isn't it?
Yes, and I accept that's
It's
correct.
not.
No, not in those. I was going to say simple terms, but not simple terms, but not in those precise terms.
Yeah. Yes, Ms. Orr.
Just finally on remuneration, Ms Livingstone, I want to ask you about recommendation 26 made by the Prudential Inquiry. The final part of that recommendation is for CBA to update its remuneration framework and practices to include the potential for an upside for sound risk management and collective risk adjustments to promote collective accountability. Now, we've heard a bit from you about how CBA has applied collective risk adjustments to reflect collective accountability. What I want to ask you about is how you think you're going to implement an upside for sound risk management in your remuneration framework.
So we have already implemented it. The CEO has a discretionary pool and can receive recommendations from throughout the organisation, and at the CEO discretion make awards out of that pool for positive risk behaviours.
And what are the sorts of positive risk behaviours that will lead to a recommendation of a disbursement from that pool?
Well, they would vary, but it could be, for example, someone in a branch who detects a particular activity on the part of a customer which should be considered for anti-money laundering, which may not be an obvious activity, but they may have, if I go back to the situational awareness comment that I made yesterday, they might have manifested very good situational awareness about that. Or it could be someone who called out a concern on a particular product and the benefit of that product for customers, or the way customers were perceiving that product. So it could be a range of factors.
And do you provide information to your employees about the sorts of factors that will lead to a recommendation that the CEO make a disbursement from that pool?
I don't know specifically whether we have more broadly in the organisation. I can't answer that question.
So you've set up the pool, but you don't know whether you've told people about what they need to do to be eligible for a disbursement?
I don't know, but it may have been the case.
Do you know whether any disbursements from that pool have been made to date?
I understand they have, but we haven't received the feedback analysis on that, but I believe that they have been.
You believe that there have been some disbursements?
I think so. I think I'm aware that the pool has actually been used, but I don't know. The Remuneration Committee hasn't received the analysis back yet.
And can you say anything about the sorts of behaviours that have led to disbursements?
No, I can't. No.
I see. All right. Now,
Well, there's the more radical idea to look at STVR and treat it as something that is marked up or marked down. At the moment, STVR is regarded as something to mark down, is it not?
It is from the 100%. The markup is between 100 and 150, if that were considered appropriate.
Yes.
the final topic I want to ask you about, Ms Livingstone, is your role as chair of the Nominations Committee. And one of the functions of the board is to appoint the CEO.
That's correct.
The Nominations Committee assists the board in fulfilling that function.
It does.
And in your speech at this year's annual general meeting, you described the appointment of Mr Comyn as the most important of the actions the board has taken to prevent the failings of judgment, leadership, systems and processes in recent years.
That's correct.
Why is it the most important of those actions, Ms Livingstone?
Because the CEO is responsible for the management of the whole organisation, so it's the CEO who, across the board in terms of their character, the way they work, what they think is important, how they get their work done, all of those elements, they will set the tone for the organisation.
And at the time he was appointed as CEO, Mr Comyn was the group executive responsible for retail banking services.
That's correct.
And that was the division that was responsible for a number of failings within CBA, including the anti-money laundering failings.
As part of the collective accountability for that, yes.
And the home lending issues that I discussed with Mr Comyn yesterday.
Yes.
The mis-selling of consumer credit insurance that I asked Mr Comyn about.
Yes, and you heard his responses, but yes.
I did hear his responses, thank you. And the board was aware of all of those issues at the time that it chose Mr Comyn for the job?
Yes, it was.
And I want to ask you about the sort of message that you think it sent to others within CBA and to the broader community to promote the person who was in charge of the division in which all of those issues occurred.
The board made its decision, and I think this is important, on a number of bases. As you probably know, we had criteria against which we assessed individuals, but in relation specifically to Mr Comyn, the board understood his perspective in terms of customers and his Better Customer Outcomes project. It understood what he'd been doing in that division in terms of the risk management implementation, so he understood controls. He led a team, and the team highly respected him. But the biggest issue for us, as I've said, is the way he stepped up at the time the AUSTRAC proceedings were lodged. So he took full accountability, including for areas that were not part of his responsibility. In fact, for me, the most telling thing was after the proceedings had been lodged, and I met individually with each group executive, and variously they came in either not having informed themselves or blaming other people. Mr Comyn came in, and the first thing he did was apologise. Apologise to me, apologise to the board for what had happened and his failings in that. He then applied himself with extraordinary diligence to understand what had gone wrong, what he could have done better, what he should have done. And I think he and we have learnt the hardest possible lesson in the most public way. And for us to have an executive who recognised that, who knows the bank, who knows what has to be done, who spent 20 years in the bank, has a commitment above and beyond, for us to have someone like that leading the bank is an extraordinary opportunity for us. Because what he will do for the bank, as part of working with his team, his new team, and with the board, the renewed board, will enable us to do what I said at the outset that I was tasked to do and have the accountability to do, which is to change the way CBA operates in a very fundamental way.
I'd be grateful if you'd consider and answer my question, Ms Livingstone, which was not about why you appointed Mr Comyn. My question was about the message that you think it sent to others within CBA and the broader community to promote the person who was in charge of the division in which these issues all arose. That's what I would like you to consider and respond to.
So my response for the internal response was overwhelmingly positive because of the respect the organisation has for Matt, his transparency, his personal ethics and his character, and his ability to admit mistakes. Externally, if I speak to investors, if I speak to people who've seen Matt now since he's become CEO, again, there is almost universal praise for Matt and his choice as CEO. So if you're asking me what's the reaction, what's the message
I'm not
sends?
asking you. I'll try one more time, Ms Livingstone. I'm asking you about the sort of message that your appointment of Mr Comyn sent. I said both within CBA and to the broader community. What message was sent by promoting the person who was leading the division in which these issues occurred? I'm not asking about the reaction or the reasons for your appointment, whether you as the chairman of the board considered the message that that was sending.
We did. We considered 4 weeks. The easy answer for us would have been to appoint an external person. To find an external person globally at that level who has not been involved in some regulatory event is almost impossible. And I don't mean that as a joke. So the message that it actually sent inside the organisation is one that these issues are unacceptable and we're determined to fix them. That was the message it sent.
And what about the external message?
Well, the external message, in my view, was the same in terms of what the feedback I've had, that here is someone who's committed to dealing with the issues that have arisen. And I would hope that you've seen that in his evidence over the last 2 days.
In June this year, Ms Livingstone, CBA announced that its Chief Risk Officer, David Cohen, would become the Deputy CEO to Mr Comyn, and that Nigel Williams would replace Mr Cohen as Chief Risk Officer.
That's correct.
What do you think are the most important qualities for your Chief Risk Officer?
The most important qualities are first to be steeped in experience in risk management in financial services, and also to have a presence and, if you like, the skills to make sure that the voice of risk is very loud in the organisation.
In your experience, is there a view among boards that risk and compliance executives don't make suitable candidates for leading the organisation as a whole?
No, I don't think that's a generalisation that we would make.
Well, do you think that there's value in appointing executives who have risk and compliance experience?
Well, yes.
Yes.
I mean, certainly.
And do you do that? Do your group executives have risk and compliance experience?
Well, the Chief Risk Officer is...
I'm sorry, I'm not referring to the risk officer. I'm talking about the leaders of your business units, your group executives. Do you require them to spend time in a risk and compliance role?
Not specifically.
Do you see value in doing that so that risk and compliance is built into the way they approach their task?
Yes, there's value if accompanied by the right skills for the other role that they may hold.
The Prudential Inquiry observed that CBA was largely aware of the challenges that it faced, and that it wasn't until 2017, in the face of external pressures, that it developed the momentum to address them. You're familiar with that finding of the Prudential Inquiry?
Yes.
And you appear to accept that the task that CBA faces going forward is a very difficult one.
I do.
And do you believe that it will take many years to complete?
I believe it will take years, but there will be stages within those years.
And how can we be confident that CBA won't lose the momentum that it's developed and in 5 or 10 years' time settle back into the complacent attitude that both you and Mr Comyn have referred to?
That is a key question that is on our minds, because we can put a lot of effort now into fixing, as you say, but is that going to be durable? Is it going to be sustainable when current management moves on, current board moves on? So I would say, and yes, it was extreme circumstances, but the APRA prudential inquiry, being an intense overview, or not overview, but inspection over that 6-month period, that is the best thing that could have happened to CBA, because it's enabled us to really develop the momentum around the change program that we have. So there is a question, I think, as to whether at some appropriate period or interval that such an inquiry might be conducted on an ongoing basis. Because having seen the benefit to CBA of the external view and that intense concentrated view across the whole organisation at one time, it certainly revealed more matters than we would have perhaps been aware of. And being independent, it's indisputable.
What do you want the board to be doing differently by this time next year?
Having to spend less time on compliance issues, because there are fewer compliance issues, would be, I think, one of the important aspects.
And what about in 5 years' time? What do you want the board to be doing differently then?
I think we'll be a very different organisation. Strategically, we will be different as we progress the simplification strategy. But it would be good if the board had far better analytics so that it could characterise the organisation on a continuous basis and be able to detect patterns much more easily. So management to be able to do this and report to the board across all aspects of the organisation. And the hope would be with good data and data analytics that that's possible.
And in your mind, how will CBA, stepping away from the board, how will CBA be different by this time next year?
By this time next year, we will have, I think, progressed our remedial action plan, and we will have more stable processes. We'll have better integrated systems, and we'll have a policy environment where probably not all, but most people progressively will understand their role and their duties and obligations in that role.
And on that slightly longer term horizon, what do you want for CBA in 5 years' time? What is the CBA that you're striving to achieve 5 years from now?
Well, the CBA, and hopefully in less than 5 years, is one that customers trust and the community trusts, and that we're delivering the products that really fit our purpose, which is for the financial well-being of our customers.
I have no further questions, Commissioner.
That's all. Mr. Finch.
No examination, Commissioner.
Thank you very much. Ms. Livingstone, you may step down.
Thank you.
Commissioner, just before we adjourn, there was a further statement provided by a representative of CBA that I would like to tender. That is the statement of David Abusa, ABUSAH, dated the 2nd of November 2018, CBA 9000001231000.
That statement will become Exhibit 7.47.
Thank you, Commissioner.
Thank you. 2 p.m.
Thank you, Commissioner.
2 p.m.
Thanks, Rowena. You want to shoot your original?